So it's still 1 p.m. It's still the 18th of August. We're still with our investment advisors. I have not read your book. Tuesday, August 18th, this is the work session of the Board of County Commissioners, joined by Naju and Liz. And what other updates do I need to start the meeting with? That's it. We're ready to roll. Thank you. Oh, and we have 2 commissioners that are not here. One is skiing, Southern Hemisphere.
Oh.
And
Where?
And,
I was like, what?
and the other is on the water at the Colorado River District. So 2 forms of water. But the floor is all yours.
Oh, hi. I'm Naju Belmont. I'm a Chief Deputy Treasurer for the county. And this is Liz Woods. Everybody knows. She's our Treasurer, Public Trustee, and Finance Director. Changing the order a little bit, sorry. I also have Ken, that's one of our new Deputy Treasurers and Public Trustee. And we're here with Kyle Perry and Chris Blackwood to present the Pitkin County investment portfolio through June 30th, 2026. Chandler Asset Management has been our investment advisor since 2016. Yeah, that's all. I think so, yes.
The anniversary.
Since 2018. Actually, yes. And I'll open to you guys.
All right. Well, thank you, everybody. Again, my name's Chris Blackwood. So in the past, and Liz reminded me of this, so I have 2 colleagues that have typically been here in the past, Scott Prickett and Julie Hughes. Julie retired about a month ago. Scott has not retired, but he's sort of moved to management. So he is mostly between San Diego and Bainbridge Island in Seattle most of the time. Yeah, really tough. He has a really tough job, right? Going to 2 beautiful places most of the time. But I worked with Scott and Julie at another firm for almost 10 years before I joined Chandler a few years ago. So it was like putting on a glove. It was very simple transition a few years ago. As one thing that Commissioner Woodruff mentioned at the outset, one thing that I did a couple years ago, I wrote a book on investing public funds. So Ted, I brought one for you.
Oh, love it.
So Ted, just so you know, I've been doing this for a long time, over 25 years. One thing I realized when we get hired for our new clients that a lot of the governing boards don't really have background in this area. And so we just jump right into the reports, right? So I decided to write the book to accomplish a few things. So if you look at it, Ted, the first chapter especially is about the state statutes. What are they? And it has like a little green box explaining in layman's terms like why this paragraph's important, because the statutes are written very convoluted. All the state statutes are. And trying to assess what they mean is difficult. So that's what I did, excuse me, at the first part of the book. The rest of the book goes through other key issues like how state collateralization works on your bank account, and then I actually downloaded the audits of every city, county, and school district of the state. I built a database, and I evaluated, like with respect to counties, I split counties into small, medium, and large, and provide like a profile about how your peers invest money. So Pitkin County would be in the large area because it was based on the investments, not the size of the county or the government. See, because I would say Pitkin is more sophisticated than like Chaffee County, right? I mean, there's just the amount you invest, and the governing boards are different. So hopefully that will be useful to you. It's got a glossary in the back of all the acronyms in our industry and so forth. So.
My dad was a muni bond salesman in New York, so I went to, bring your kid to work day a lot.
Yeah.
And I always left there a little late days. And what are we doing here? As a little kid. And this will surely finally clear it up for me.
Yeah. And I worked on trading desk for years as a municipal bond director of research. So I was on the debt side of the business before I moved to this side. So anyway, I've got sort of a broad-based background on all that. So please feel free to ask questions. So before we go through this, this presentation is put together in the same type of format. We generate this report quarterly for staff, just so you know. The first part goes through an economic update. And the reason we do that is the economic environment really sets the stage for Federal Reserve interest rate policy. It affects interest rates, and those interest rates filter through to the portfolio for the county. So and then there's lots of detail in this report and on holdings and so forth, lots of minutia. The staff gets detailed reports in statements every month and so forth. So feel free to ask questions as we go through this. So I'm not going to read the sort of the summary because I'm going to basically verbally talk about this, and Kyle's going to help add color commentary as we go through this also. So the Federal Reserve is the central bank of the U.S. They have a dual mandate to maintain employment at full employment levels and to have policies that also keep inflation at a target, which we'll talk about here in a minute, of 2%. So we always start off with this, sort of the two factors that get talked about in the Federal Reserve's meetings, and that's the labor market. So the labor markets, there's a lot of indicators. The two key ones that everyone focuses on is what's called payroll employment. So that's basically payroll in the non-farm sector. The graph on the left sort of shows you that. So, even without reading the numbers, you can see what's that graph doing. The numbers are going down, right? The pace of employment growth has been shrinking. In fact, last month it was a negative job post last month, and the prior 2 months were revised downward. They always, just so you know, when these are survey-based numbers, and they always get revised back 2 or 3 months after every monthly revision. So these revisions are not unusual, but the extent of the revisions downward, it was somewhat unexpected. So the labor market is sort of in a weaker position. Like previously, I would say, it's sort of plodding along at low rates of growth, but now we've got some negative numbers filtering itself through the labor markets. Despite that, the unemployment rate is 4.1%, and that's not bad. It's not. You can see the unemployment rate chart on the right isn't really floating up very high. One reason is because the labor market is shrinking. The number of people looking for jobs is shrinking. So when you divide the number of unemployed people in the labor market, it's not horrible right now. The labor market, if you look underneath the covers of the details, the labor market has a lot of, we're sort of in like a no hire, no fire environment. A lot of companies are sitting on their hands right now because of really what's going on with AI. And so it's sort of going sideways, except now, as I said, we've had some losses the last few months. So this is one thing that will obviously come up at the next Federal Reserve Open Market Committee meeting, and we'll talk about the Fed in more detail in later slides.
And if I might add on that non-farm payroll number, is this thing on? Just
I think we are on. Yeah.
Thank you. So that as Chris mentioned, the July number that we got was negative 23,000 jobs lost, and I think a bit of a caveat, just as we can all go back and remember the World Cup was being hosted, and so part of that number was due to the World Cup ending, right? And so there was a bit of a pickup the prior month, and then a bit of a washout the following month. And so I think it's also important to note that one data point, it doesn't really create a trend, right? So we're watching this over the rolling months as they are. But May and June, Chris also mentioned there were some revisions. We did get a revision of 103,000 jobs, which is a fairly substantial number. So certainly something that we're still watching. But as he also mentioned, 4.1% unemployment rate is still in a pretty healthy position.
So another number that we look at in the labor markets is what's called the job openings and labor turnover report. So this report goes back on this page. Let's see, I'm gonna get glasses on. Goes back over 20 years in this particular page. So you can see how the job openings started to, after the financial crisis, it really killed the labor markets. Pandemic temporarily hurt the labor markets, but then there was just a huge demand for labor following the pandemic, and that has now normalized. So now we've got, let's see if I can see what the numbers are. Yeah, so we've got 7.6 million people of job openings. Just to give you context, so the number of unemployed people in the U.S. is about 7.3 million. So if it was a perfect match, the unemployment rate would be 0. That's never the case. But it's more balanced in that respect. right now. The job openings are sort of very uneven right now, sort of going sideways the last few months. So we're not seeing a huge demand for labor. I think a lot of companies are, as I mentioned earlier, are trying to navigate, what are we going to do with these AI tools, and do we need to hire people or not? And in the software industry, especially the industry that's called software as a service, is sort of the acronym for it. That whole industry, my son is actually a software engineer, and he got laid off, not because of AI, because his company wasn't making money, but trying to get back into that industry. It's like literally that industry has gone 180 degrees. If you can't use AI tools, agentic tools is what they're called, as a software engineer, then you don't need to code anymore, to be honest. So it's really flipped the industry a lot in the labor markets.
And just on a, a local level, so job additions in the Pitkin County, if we just narrow it down from the broader to the Pitkin County level, up 1% on the most recent. So in a good place, and from an unemployment standpoint, at 4%. So slightly below the national average, which is a pretty good place at the county level.
So now switching to the factors that affect this big inflation spike we've dealt with this year. As you know, the war with Iran has really affected oil and gas prices with the closure of the Strait of Hormuz. We thought it would, the administration indicated it was going to, this war was going to be short. It has not been short. It's continuing to roll on, as you know. You can see in the social media and the news feeds every day what's going on with that. So the outlook for that is like, your guess is better than mine, to be honest. I have no idea when this might end, but right now, this closure is keeping oil prices elevated. So, in fact, I just looked today, so the prices mentioned in the paragraph on page 6 are really sort of near where they were. They're slightly above these levels right now. I think West Texas Intermediate is about 70.
As of yesterday, it was at 80.53.
Yeah,
So,
yeah.
In June, things kind of reaccelerated over there in that zone of the world. And so that's why you see a bit of an uptick from this data as to where we are as of yesterday.
Yeah. So prices are remaining elevated, and that's, I think I heard on the news last night in the Denver area, gasoline prices are $1.30 per gallon higher than they were a year ago. So that's obviously not a positive to have these, and it's filtering through to overall inflation levels, not at an extreme level, as you'll see here on the next page. So there's a lot of inflation indicators. These are two big ones that we normally look at. The Consumer Price Index, which is the one that most gets reported that the average person has heard of. It's been around for a long time. But the Consumer Price Index, even though you could see it's definitely, it's spiked above 4% in the last few months. The most recent reading, I think the core level came in at 3.5%. I can't read your hand notes.
The CPI came in at 2.5%, and the headline was 3.4%.
Yeah, headline is 3.4. The core is 2.5. But the PCE, so I'll give, the PCE is the Fed's preferred measure, okay, because the PCE has a basket of goods that changes more dynamically than the CPI when there's substitution effects on price on goods that are purchased. Now, again, without even looking at the numbers, look at the chart. The line's going the wrong direction. It's moving away from 2%. So the most recent numbers are, Kyle?
Yeah, so at the broader national level, 3.3% at the core. So that's pretty far away from the 2% core target that the Federal Reserve has, which is indicated in that red, we call it Bronco orange line there. And then on the headline basis, still at 3.7%. And so that's still, energy prices are still elevated, less so than the prior reading, but they are still elevated from that standpoint. Now at the Pitkin County level, that's tracking right about 3.9%. So in the same realm, as I came in, I did notice that gas was very much more expensive than the Denver area. So for example, and so that's certainly something that flows into these inflation metrics.
So one thing that you're going to hear more news on, so again, I'll go more to this detail. So we have a new Federal Reserve Chair, Kevin Warsh, as you probably know. he has mentioned that he cares more about another inflation measure you probably haven't heard called. It's called mean trimmed inflation. It's produced by the Dallas Federal Reserve because these core numbers that we just mentioned here exclude food and energy. The reason they exclude food and energy, those are typically volatile measures, and they've been the commodities that have been excluded in this core measurement for years, both and in the CPI also. But I think when looking at other measures, the mean trimmed inflation measure not only excludes these items, excludes any item that is extremely high because of oil and gas prices. For example, airline prices are up like 25%. So it could exclude any item that is historically out of line. And so that number on a core basis is only 2.2%. And Kevin Warsh has mentioned that he likes that inflation measure better. Now, he didn't really mention it in the minutes of his meeting so much, but you're probably going to hear him talk about this more. Because why is that important? It affects Federal Reserve policy. If they think they're, a full percentage point away, they're going to have a different policy than if they're almost on top of the number. So we'll see. We'll talk more about that in a minute.
Oh, maybe you'll mention it later. They're task forces, and I'm sure we'll dive into that.
We'll talk more about what else is going on in the Fed in some later slides. Okay, so the reason this slide's up here, consumer spending accounts for about 2/3 of GDP growth in the U.S. So keeping track of what's going on with retail sales is sort of important. So retail sales is turning around some, but it's almost like a false indicator of strength, because, the most recent numbers in this, I got to get my glasses on here.
Yeah, 6.7%.
6.7%. Sounds, because even on an inflation adjusted basis, it's up. But a lot of that's been driven by higher income taxpayers. The higher 20% of the taxpayers in the U.S. are driving a lot of the retail sales growth. And guess why? Because what's gone on with the stock market. It's had a great year, despite. If you at the start of the year, if you talked about the war at the start of the year and the effect of inflation, I would bet you these numbers wouldn't have come in like this, or the stock market wouldn't have performed as well. But we didn't know about the AI boom so much, which has fueled the stock market. So that sort of fueled some of this growth. But when you do surveys of an average person about their viewpoint on the economy or their job prospects in the Consumer Confidence Index on the right, you can see that number is going down. It's below 100. It's been below 100 for all year long. So those numbers are not, the average person, because of these price increases, doesn't have a great viewpoint on the economic prospects right now. So that's sort of a damper on the consumer market right now.
Yeah, and I think if you dive under the hood of that 6.7% number, something that is important to look at is eating out, right? Because that's kind of a good pulse, if you will, on are people still out there? Do they still feel like they have enough money to go out and eat or go out for drinks and that sort of thing? And in that reading, eating and drinking out is the category. It was up 6% year over year. So really from that is, and Chris mentioned it, with the higher 20% people, they still are out there. They still are spending money. And so that part of the consumer is surely heartily resilient.
So a couple of other indicators that we watch, these are like future-looking indicators, the index of leading economic indicators and the Chicago Fed National Activity Index. They're highly volatile. They have a number of elements to them. They're both below sort of the average levels. Neither one of them show a potential signal for recession at all. So, the economies continue to grows, is continuing to show growth, which we'll look at the GDP statistics in a minute. And, even with these the higher equity prices are a contributor to the leading index of leading indicators. As I mentioned earlier, the stock market's done fairly well this year, so that's been positive. And so from a future-looking standpoint, we're not. These indicators don't tell us we have fast growth, but we're continuing to have sort of modest growth ahead, is what they would sort of be raising the flag on.
Yeah, slightly below historical trend growth. Yep. So
housing starts. So this is a big deal because if if people are buying homes, it creates a multiplier effect on spending, because when you buy a home, you buy furniture, you do landscaping for your yard, and that creates higher retail sales. It creates higher sales taxes at the local level. So watching this nationally and locally is really important. Well, the whole housing market has sort of sunk over the last few years because, in 2022, interest rates went up extremely sharply, which affects mortgage rates. Mortgage rates, as of this morning, a 30-year was at 6.75. Now, and so that's put a damper on the housing industry, both residential and non-residential, and higher prices. You can see the chart on the right is a national index called the Case-Shiller Index of 20 cities, and you can see the huge spike in 2022 on home prices, almost 20% up that year because of input costs. It's come down. It's slightly above zero right now. It's fairly low, but you've got high costs of housing, just to construction, and higher mortgage rates. Now, historically, here's the problem. Historically, mortgage rates have been in the 6% range, but I think a lot of people who bought in during the pandemic got hypnotized thinking 2.5–3% mortgage rates are normal. So it's really those low rates create sort of a drag on future growth now, because if you bought a house then and you had a small family and you wanted to move, you're going to be giving up that 3% mortgage for a 6% mortgage and at a higher priced house. So it makes it very difficult to transition to a newer house, and it's creating the resale market is sort of under duress because of that. And then locally, I know Kyle's probably got some numbers.
Yeah, so from the Essen report, just Pitkin County, real estate sales were down, according to this report, 30%, and some of those transactions, 12%. So I think that tracks, especially with the Denver metro, the Colorado area. Colorado in general has been experiencing a negative net outward migration. And so there's more houses sitting for longer on the markets these days.
We should bring back the 0.54% yield on the 30-year like we had during COVID.
Right.
That would move some houses.
30 years 5.30 or something, right?
You're at 54 basis points. We were at 0.54.
Yeah. It's hard to believe, right?
I can remember 8% yields.
So. To be honest, it's hard to believe I had a job during that time, generating returns of under 1%. Another index that we watch is the Purchasing Managers Index. This is a survey, a national survey of purchasing managers. The unusual part, we're mostly a service-based economy in the U.S. We have been it's been transitioning for the last 40, 50 years. So seeing that part of the index.
Your slides are old, by the way.
Pardon? Yeah.
Yeah, so
okay, what we have in front of us is more recent.
What you have should be the updated as of last Monday.
Yeah. What I see on this screen is more data than what I had looked at this morning.
Thank you.
Right? Yeah.
Yeah.
So you've got a more recent book, right?
The only number that should not be updated on this one was the housing starts. So that was the latest reading. It was down 12% month over month. The prior was up 16%. So a bit of a retraction. Everything else, I believe, should be current.
I'm just waiting for your Fed forecast for September.
Yeah, we're coming. I'm putting the ball above the rim here.
Keep going.
All right?
Let's go.
All right. So, but here the big takeaway on this one, the one change on this chart here on page 11 is the manufacturing index has been up after being down for the last 3 or 4 years. Most of that is AI construction related and defense industry construction related, which has been just there's been a lot of pressure. Because of the war in the Middle East and with Ukraine and just production, Defense Department production, and the AI build-out, which has been historically unprecedented across the U.S. So that is boosting not only manufacturing levels but also prices, which is feeding into that higher index number. Lastly, the snapshot on GDP. So this GDP is the measure of output of all goods and services in the U.S. The overall measure, so again, this is data, what I have on the screen here. The most recent number is up 1.5% in the second quarter. down from 2.1% in the first quarter. The consumer spending was sort of anemic. It was positive. But, 1.5% number doesn't portend strong growth. So, again, doesn't portend a recession at all. But we continue to sort of plod along at sort of a moderate level in terms of growth.
Yeah, and there was a bit of a drag. So if you look at the net export and imports, during that time period, there was a mass of importing with chips, data center related items massively being onshored. And so that created quite a large drag to the GDP number in general, but certainly the net export and imports to a net position of -1%. So yes, there is money being transacted and dollars being spent, but that, at that level was kind of the drag in this period. So, looking under the hood of the 1.5%, if you just look at that number, yes, it is a bit smaller, but diving in a bit more, the personal consumption expenditures at 2.1%. That was up from 0.4% the prior period. So it's good to see that the consumer, as Chris mentioned, not burning holes in anybody's pockets, but they're still spending, right, at 2.1%.
Okay, now let's talk about the Federal Reserve. That's the biggest change we've seen. So Kevin Warsh became the Federal Reserve Chair in the middle of May. Jerome Powell, normally the previous chair leaves the board, but his term actually as a governor goes through 2028. He decided to stay on the board. Most of the reason for him staying on the board, even though he's not on the FOMC, is because he, as he said in press conferences, he wants to protect the Fed's independence. As you know, he was attacked quite frequently by the president, and so he wanted to stay on the board to sort of provide a sounding board. And so even though he's not doing any interviews since he's left the chairmanship, so the Federal Reserve does a number of things, but the key things that hit the newspapers is where do they set interest rates? The federal funds rate is the overnight interest rate they set. That's at a range currently of 3.5% to 3.75%. We've been pretty stable this year. Last year they reduced rates 3 times because the economy was weakening. There was an expectation at the start of the year the Fed would reduce rates twice this year. That has not happened. With Kevin Warsh, there's been lots of changes. He was on the Fed during the financial crisis, left in 2011. He's actually fairly well respected, but he has mentioned a couple of changes. He's mentioned. He said that he's going to change the communication methodology. He's going to communicate less frequently, and the press conferences are going to have less words, which they did. He also created 5 task forces of really prominent people on these task forces that are going to address a number of things like communications, ethics, the balance sheet, forward guidance, and so forth. So one of the things the Fed usually releases every quarter is what's called the dot plot. They do an anonymous survey of all 19 Federal Reserve presidents and people on the Fed board. They ask them where they think rates should be for the Fed funds rate at the end of the current year and the next 3 years and long term. Then they plot those on a chart, and that gives the market some insight about what they're thinking about future rates given the economic environment. Well, at the June meeting, dot plot was released again, except Kevin Warsh did not put a dot on the chart. So that sort of tells you where he's going with this. Now, he's got this dot plot came out in 2012, and so we'll have to wait and see if and how he gets rid of it. But he's pretty much made it pretty clear he thinks it's not useful in the markets. I mean, it's not a great predictive tool. It never has been, but it gives you an idea of the divergence of opinion on the future outlook of the Federal Reserve members. The last meeting, I think at the July meeting, right? The July meeting, 3 members voted to raise rates, and 9 to hold stable, none to reduce rates. I think, is that correct, Kyle?
That's right.
Right.
Yeah.
So the reason you had 3 people raising rates because of the higher inflation, right? And Warsh, as you probably know, it's pretty clear the president has pummeled the Fed to reduce rates this year. Well, the cards are not on the table given inflation. And now we have a weaker labor market, right? That sort of takes some of the pressure off, at their next meeting, which is going to be middle of September. Now, the reason that this particular number is so important, you've got a significant investments in 3 local government investment pools here in Colorado that act sort of like a money market fund. If we put a graph of those yields against the Fed funds rate, that chart on the right, they follow it very closely. So whatever happens with the Fed funds rate will filter through to pool yields. Now, it doesn't directly affect longer term yields like a 2-year or 5-year treasury or 10-year. It influences them, right, with their expectations. And then the left side, is the Fed's balance sheet. This is one of the things Warsh has been most critical of. He thinks the Fed has integrated itself into market activity too much. He thinks the Fed balance sheet is too large. You can see going back before the financial crisis, it was about an $800 billion balance sheet. It peaked to about $9 trillion, and now it's down to under 7. So he wants the Fed to, sort of get out of this business of messing with the markets so much. So again, that's one of the task force. They're going to investigate how this policy should be rolled out. What should the Fed's role be in the overall economy with respect to its balance sheet? And the reason that this is important, when the Fed increases their assets, they're basically printing money to buy securities. So during the financial crisis and the pandemic, they bought securities to push rates down, longer-term rates down, like mortgage rates. But when they do the opposite, when they shrink the balance sheet, that puts pressure on rates to go up. So, so if Warsh, it'll be very interesting to find out what the task force says, because if he really wants the balance sheet to shrink, that's going to push like mortgage rates up, not down. So he's going to be walking a tightrope, I think, in future meetings.
Chris, couldn't he be doing from a tightrope standpoint, if you're reducing your balance sheet, you don't need to cut interest rates.
Right.
Sorry, you don't need to raise interest rates.
Right, because they'll sort of do it on its own, right?
You don't have to worry about overnights. You're going to get 2s out to 30s are going to get steeper anyway.
Yeah, the curve's going to get steeper, and we've seen a lot more.
Light way of not yielding to political pressure.
Yeah.
Because the headline's going to look the same. Fed leaves rates unchanged, but you let your balance sheet continue to expire, or you let paper roll off.
Yeah,
and
that's
so you're
right.
reducing liquidity that way.
Yeah, that's right.
Not bad.
And there's some merit to that argument, right? Where over the last, let's call it 4 or 5 years where rates were so low, a lot of people termed out their borrowing. So companies, they borrowed longer with shorter rates. Obviously mortgages, a lot of people borrowed at, 3% in that ballpark. And so, there's an argument that could be made that rates are maybe a larger lever than they previously had been due to that interest rate environment we're in. So to your point, Commissioner, there's could be some merit to that argument of that being a good lever to have a more restrictive policy stance rather than moving rates.
Political middle ground.
Yeah.
Yeah, and I think it's also one of the task forces that I thought was interesting. The 5th one was looking at the data that they're looking at. So, if we go back to the 3rd quarter of last year, the government shutdown, they did not have the BLS and the VEA data coming in, and so they had to kind of scramble and look at different data sets that they maybe typically weren't, one of those being the private payrolls. And so I think that actually could be a good thing that they're having a task force. And they're filled with Stanford professors, Harvard, they're as Chris mentioned, very well-respected individuals. And so I think that could be a good thing, is evaluating what data we're looking at and maybe broadening it at the Federal Reserve at that level. In markets, prior to some of the most recent data we had at the September meeting, it was a little bit more than a coin flip as far as raising rates. The markets were pricing that in futures contracts. Then we got that lower jobs print and some calmer than expected inflation, and so now those have subsided well below a coin flip. And so, Chandler, we're not looking for a rate cut or any rate movement through the end of the year. And markets now are pricing in a lower percentage of that as well.
So what does that affect on interest rates? So the charts you see right now.
A question.
Oh, yes.
Just a lot of talk about Federal Reserve, but not a lot about bond rates with regard to federal deficit, and that seems to be happening even today. So I didn't know if that was going to come into the conversation. here,
So
because-
this is more big picture policy
yeah.
question, Ted, right? I mean, my entire career, like for 40, like almost 35 years, they've talked about the Fed's, deficit crowding out private investment, and it just has not happened,
Okay.
right? Given the trillions of dollars of debt that we have. At some point, you'd think there would be a reckoning, right? I mean, lots of people have talked about this for decades. I think the only thing I can think of is that the overall strength of the United States economy is, sort of helps to trump that deficit move. I mean, you would think that at some point you would run into a corner and you'd see a reckoning on rates, but it just hasn't happened yet. So
Yeah.
I sure don't have an answer to it. I know it's been talked a lot about in the media, and some of the Republicans especially are deficit hawks, right? That didn't like some of the spending that's going. I mean, last month's deficit was historically very large for the federal government because of all the Defense Department spending, right, going through the roof. So we'll just have to, wait and see about the effect. And frankly, the bond market, the good thing about the bond market, it is going to be a quick indicator about their viewpoint on policies. They will have a fit, right? I mean, rates will go up very sharply if there's an extreme concern about this, right? So, so the charts that you see on the screen now, the biggest change over this past year, a year ago, the dotted line on the right from June of 25, you'd see an inverted curve out, beyond 2 years. When I got in this business, there was an old adage that the yield curve points the direction of future rates. So if the curve is inverted, it tells you the rates are going to fall. And they did. In 2025, rates were reduced 3 times. Now the yield curve is positively sloped, right? And rates have gone up here in the last few months, even because of the higher inflation reads. So the curve is now positively sloped. The 30 years over 5% now. So this is dated numbers on this screen, right?
Right. Yeah. Today, the 2-year, slightly before this meeting, the 2-year was trading around 4.18, and it's been hovering around 4.20 plus or minus. The 10-year, and I think you mentioned it, Commissioner Woodruff, when we walked in prior to this meeting, it was about 4.71, and so it had been reaching into the 4.70s, which it had not been for quite some time. And those are part of that is in inflation expectations.
19-year high.
Say again.
19-year high.
Yeah, 2007 is that? Yeah, that's what.
Yeah.
And the federal deficit, it's at 39 point something odd trillion. It's expected to hit 40 by the end of this month. Federal deficit, I think, was at around 1.4 trillion, which is up almost double digits from last year. So certainly something that people are looking at. But again, the U.S. economy at 30-some trillion is still very massive, and obviously traders and the bond market thinks that we can still maintain this pace, so to speak, or maintain where we're at, rather. For now, if things start to get out of balance, again, the bond markets, will have an answer for that.
A better context looking at it, and I don't have any chart on this, but is the debt to GDP ratio, right? We're over 100% in the U.S., like maybe 120%. Most recent reading, give you some context. I think Japan's like 200% or something. So, when you get over 100%, it's a bigger deal, right? But we're having such growth this year. It'll be interesting to me to see once the AI trade and build out is done, which has fueled a lot of this growth, how the markets will react to all these numbers that we're seeing. But yes, ma'am. You have a question? Okay.
I'm just.
I'd be rubbing my hands too.
And just wondering where it comes back to where we are going as a county.
That's what I mean.
So
And
next page, please.
This is great, and I don't know if you're going to get to the crystal ball of it.
Yeah.
But,
So let's talk. What does this all mean for the county's portfolio? So I'll let Kyle start this process up. I'm jumping to page 16.
Yep, that's page 16 on the handout here. So rates have gone up, right? We mentioned that already, and since there was a peak in July where rates had moved up significantly with the reacceleration, why do we care? Why does this portfolio care? Why do you all care about all that we just had mentioned? And part of it is, and I'll get to it in a page or two as well, with these elevated rates, we are also reinvesting it in a higher level. And so this portfolio is not a short-term hedge. We're not doing day trading, right? This is for the long run, and it is well positioned for the long run. And so reinvesting in those higher rates ultimately will benefit the county. So on this page, of course, we always like to start off with the objectives of this portfolio. First and foremost is always safety, and then maintaining liquidity in the portfolio. And then third, in that order, is a commensurate rate of return. In that order. And so the statement of compliance on the next 3 pages, you'll see that we're compliant in each of those categories, clean bill of health, both with your investment policy and Colorado revised statutes. And the portfolio characteristics is where we'll go next. So this is 630 data again. If we go down to that average modified duration line, 1.84. And looking against the benchmark, your benchmark, as a reminder, is that 1 to 3 year Treasury and Agency Index. That was 1.75. So the portfolio is slightly long of where the benchmark's at, and that's what we're targeting. And I think as you'll see through the next quarter or so, that we will be looking to maintain right about neutral, slightly long of the benchmark in that area. Conservative approach to what's going on now and where we're positioning your portfolio. Now, the average purchase yield there from 331 to 630, you can see it went up about 3 basis points to a 392. Now, the average purchase yield, that number is if we just held everything in the portfolio to maturity, right now that's what it would yield. And we do. We hold everything to maturity and then reinvest where we see fit moving forward. So we never realize losses if we're we're not selling. So the next line is your average market yield, and you can see that also went up quarter over quarter. And that's the rates that we're talking about. A pretty significant move from 382 to 413. Now, why does that matter? So as I mentioned, it's a double-edged sword. When we're reinvesting in higher rates, that's great for the long term, and that's income generation. That's real income generation. On the other side of that, that creates some unrealized gains or losses. That can create some unrealized gains or losses in the portfolio. And so you'll see later on the performance that in the last 3 months is different than the prior period, to be expected. But again, this is over the long term. And I think we are positioning well for the long term. Now, the next line, average quality, AA plus, and then the total market value, just over 152 million. You can see from the prior period the 132 million. We did add on the 15th of May 10 million, and then another 10 million the following Monday on 5/18. For a total of 20 million. And that was, again, good timing, reinvesting in slightly higher rates than even just a few months prior. So
That money came, I assume, from pool, the normal. So I think Liz can correct me if I'm wrong, but I think that just came from the staff determined they had excess liquidity and could put it out longer term into the portfolio, which was beneficial because the return of this portfolio is higher than pool yields currently.
So your sector distribution there, so just looking quarter over quarter of what we have in the portfolio, our bread and butter, really the U.S. Treasury allocation went from 81% to about 77%, still makes up the majority of the portfolio. Agencies went down slightly. Now, agencies, we try to pick those up as often as we can, and we like those for diversification, but we try to get them on a new issue where there's enough spread over a Treasury to make it worth our while for that liquidity and elsewise. Now, looking at corporates, 6.57%, and we'll go over a few of those names in a few slides of who we're holding in there. The next slide is your duration allocation. So looking at commercial paper, corporates, money market, your treasuries. I'll draw your eye to the agencies, which is the darker green. You can see we're pretty well diversified just across the curve where we can find value in those. You see them in the half to 1 year, the 1 to 2 year, and the 2 to 3. You also see corporates in that same time frame, abiding with Colorado revised statute, always 3 years and under those maturity dates. And looking at your duration distribution against the benchmark, so again, the 1 to 3 year U.S. Treasury and Agency Index, you can see we're pretty well spread out across the curve compared to that benchmark, which is in the gray bar. We're in the green there. The 3 to 4 year, about 10%. the portfolio has, looking at the 4 to 5, about 7%. So as we mentioned earlier, locking in some of those rates for longer without going, too far. We're still managing your duration in an adequate manner. So your issuers here, as I mentioned earlier, U.S. Treasuries make up the bulk of the portfolio. You also see Farm Credit System, Federal Home Loan Banks. Now, that Federal Home Loan Banks, you'll see us add those. They are issuing, so we'll try to pick up those new issues as often as possible. So you may see some the next time we meet. You also have your corporate names, kind of your household names, very secure, very large balance sheets. Your Meta, BlackRock, Amazon, Alphabet.
They're all rated AA or better.
Correct. And Alphabet, excuse me. Yeah, thank you, Chris. AA better. So well diversified. Quality distribution there. So AA really making up the bulk of the portfolio there.
And just to remind you all that the federal government was downgraded by all three rating agencies now to AA plus. So there's the only AAA security in here is probably the money market fund allocation. But you can't, and there's very few AAA rated corporates out there anymore.
Are the agencies generally callable?
No, we usually don't buy callable agencies. We usually buy non-callable agencies, and they're rated the same as the federal government, by the way.
Thank you.
Oops.
Yep. Okay. So kind of the report card, if you will, really where everything adds up to is your performance page here. Again, this is as of June 30. I think just at a high level, let's look across the graph there. The green being the portfolio, the gray being the index. Just looking across there, we see outperformance in every one of those time frames. And this is a total rate of return. So this is looking at your interest income plus your realized and unrealized gains and losses. And this measure is really best shown over time, and you do see that in the portfolio where over time there is consistent outperformance against the benchmark. As I mentioned, the 3-month period there, 0.44 versus the benchmark 0.39, which is still 5 basis points of outperformance, a bit shorter because we did get that raise in rates. But as I mentioned, it's a double-sided sword. But I think in the long run, you'll see we're mostly cutting with one side of the sword.
To give you a context, so that 12-month return is at 313. So if our average reinvestment yield during that time frame is 4%, the difference between the 4% and the 313 is unrealized losses. In other words, we have to mark to market the portfolio as if we have to sell it in the monthly statements and in these reports. So when rates go up, the market values decline, right? But it's an unrealized loss.
Bless you.
So if you go out to the 5-year period there, that's a pretty significant period of outperformance, 28 basis points. The 3 years at 13, but I'll just draw your eye lastly to the since inception, and this is January 1 of 2019, 17 basis points of outperformance there. So as I mentioned, well positioned. And then lastly, so we spoke about the average purchase yield on the characteristics page. So this is the historical average purchase yield. You can see it has gone up, and it has plateaued over the last few months, and I would expect it to continue to plateau, hang around there in the 3.90 to 4% range, because we have securities that we purchased a number of years ago at 4.70, 4.60 rolling off. We also have securities that we purchased at 3.40 rolling off, and we're investing, as I mentioned earlier, in the over 4% range. So continuing to add to this income generation portion over the long run will really benefit the county.
Wrap up questions or comments, or do we need to ask our next speakers to hold off for 10 minutes? Sorry.
Yeah,
Oh,
we're running against time.
Oh, okay, we can skip, yeah, we can skip to that
That was
portion.
my
This-
polite way of saying.
Thank you.
Yeah, no, thank you for that.
I think we're pretty much,
The next page is just your LGIP portfolio. We'll just go down to the bottom line, the total market value,
so you're-
138 million.
yeah, you're in 3, I'm gonna jump ahead to page 30. Yeah, so you're in 3 local government investment pools. The staff allocates, we don't do any allocation, staff just allocates. They're all AAA rated funds, have slight differences in how they're managed, but they're all, comply with state statutes, AAA rated.
Yeah, and then lastly, just that page 32, the at a consolidated basis, looking at everything, 291 million. Your average purchase yield of 386. So on the whole, a good-looking position there.
All right. And the rest of it's a lot of detail that we're not gonna go through, like the holdings reports and so forth, so, unless you have a question on any of that.
Which way rates are going?
Are you talking to me?
Yeah.
You know, you would think these higher inflation numbers would have been fueling the higher yields, right? I mean, I think again, as a firm, we think the Fed's gonna be on hold the rest of this year.
Okay.
You know, I think, the weak labor market number just definitely gave them some relief, compared to the next meeting. I doubt we'll get 3 governors voting to raise rates at the next meeting. The markets for sure are not pricing that in. You know, the real, I guess, question is how long the war in the Middle East is going to go on and completely continue to choke off oil and gas supplies, which is fueling. It's an external. This is the hard thing. It's an external element to inflation, right? This is, you know, I thought about this. Like if I was on the Federal Reserve Board, and I wanted to raise rates because of a higher inflation. This inflation isn't demand driven from inside the U.S., right? They'd be doing that to try and they'd be reducing demand for external inflation. And it's my guess why some of the governors don't want to raise rates right now, because that could here's the hard thing. Even if there was a complete agreement now and ships started moving through the strait at a normal amount, it's going to be, 3 to 6 months before we see the price effects, right?
Yeah, that's true.
I know, so.
Yeah, if you just think of transit times right through from the Strait to Asia, that can be 3 to 4 weeks just to get the oil there. If you're going the other way to the United States, that can be 6 weeks or more, right? So just to get it there, to get the oil flowing, it would take some time if it opened up tomorrow.
I mean, the president did, on this front, I'm trying to think what the word is. He temporarily suspended the Jones Act, which requires that you have to, the Jones Act required that any fuels moved in the continental U.S. have to be on a continental U.S. ship, but we don't make ships anymore. So they suspended that so they could have ships made overseas moving oil and gas, let's say, from Louisiana up to New England, for example. So that helped with prices some, but again, it's a small.
Yeah, and just, to answer your question, Commissioner Mahon, Chris mentioned, we don't see rates moving at all throughout through the remainder of the year, but we do not foresee the next move being a raise in interest rates right now at our firm. So
reduction in balance sheet.
Yeah, it'll be.
It's the secret raise.
Yeah, no, that is. You're right. If he starts shrinking that balance sheet, the long rates will go up. Right. Well, we'll see. He's in a tough position.
Closing comments.
I don't think so.
Liz, Ken.
Thank you for your time.
Likewise. Thank you.
Is it autographed?
I'll autograph it.
I just want to know, Steph, so you're comfortable with where we're going
Yes.
and seeing the unforeseen in the future?
I mean, I don't know if we ever see the unforeseen in the future, right? But I think we're very comfortable with where we're at. We have a good mixture of liquid assets that are in those pools, and we're investing as much as possible because we do see that the rates are kind of, staying at a fairly high rate, which, helps with our investments. Fortunately, it does not help with our bonds when we go to issue bonds. So it's, again, that double-edged sword that we're dealing with.
That's kind of where my concerns are laying.
Or building with plastics and petroleum products.
Yeah.
Just watching the news this morning, as I'm watching the news, the price per gallon or per barrel of oil is going up as they're speaking. And I'm like, and so what is it going to be by the time I get home this afternoon and turn the news back on?
Chris and
Scary
Kyle,
out
great to
there.
see you. Thanks for your time.
Yeah.
Likewise.
I love
Nice
you
to
guys'
see you all
passion
again.
and
Thank you.
and your knowledge is amazing.
Thank you.
Thank you for having us. It's always a pleasure to come and visit your beautiful county.
Thank you. The polling company. It just seems like an acronym for acronym's sake. I love it, Chris.
Thank you. My extended family are all still back on the East Coast doing bonds in different ways, so.
Policy Confluence, I believe that.
Oh, it's not Policy Company.
Yeah, right. Give me just a moment to get some visuals for you.
How come your company name is bigger than your name? I can't read your name.
Oh, is my name on there?
Under-
Oh, this tiny little, Polko Sonia Wittink.
Nice to meet you.
Executive Vice President of Data and Insights at Polko.
Wonderful. Thanks for joining us.
I'm just still trying to read this fine print.
Yeah, there were a
Thank
couple.
you, Chris.
There were a couple fonts used in this presentation that we don't approve
Yeah,
of.
but it's interesting stuff.
The lettering and the kerning could be better.
I mean, we're being tasked with solving the Armory and the Castle Creek Bridge.
Oh, of the,
Yeah, the
one-off comments?
Unfortunately, you're right.
random comments.
I see what you mean.
I was into that one.
If only we had the power
Yeah.
and the authority, and it was in our jurisdiction.
Flattering.
Yeah. I mean, generally speaking, people don't know who's in charge of what.
Yeah, and they always ask me why I wasn't in a city council meeting, because I'm the mayor. Like, no.
Starting with AI, it must be a good presentation.
Would you like for us to start now? Is that a good? Well, thanks for having us. I'm Alycin Bektesh, the Strategic Communications Manager with Pitkin County, and we do have a guest today, Sonia Wittink from Polko, who is our survey administrator. So this is the first time we have used Polko in the biennial survey. The previous decade was a lot more one-off specific questions throughout our departments. We selected Polko for their national community survey, getting some longevity and longitudinal data into our questions, and then allowing us the opportunity to do very specific polling moving forward in those 2-year gap years with their many survey tools that we now have access to. As of today, after we present this to you, all of this data is also going live online for anyone in the public to look at and play with, so we're really excited about their interactive tool. But of course, wanted to show you the results first. The presentation is brief enough that you will have a lot of time at the end for questions. So sometimes I say butt in. I think in this case, if you can watch it through, a lot of times the next slide will have that answer. And then we can save all that time for questions. Of course, if something is not clear, we're very open to you asking questions. But even myself, as I was watching, a lot of the questions do get answered as we go. So without further ado, so we can get through the presentation, I'd love to pass it over to you. And thanks for coming up. She came up from Boulder for us.
It's lovely to be with you guys today. And as she said, I'm the Executive Vice President of Data Insights at Polko. I've been with Polko/National Research Center for 21 years. National Research Center started 30-some years ago in Boulder as sort of a fractional research center for communities across the country. So today I'm going to run you through the results of your 2026 National Community Survey. And before I begin, I would like to say thank Alycin for all of her good work with us. She provided a lot of thoughtful input throughout our process. And then I'd also like to acknowledge my colleague, Jason Newmeyer, who's not here, but he was the project manager for this implementation. So just to start, a little about Polko. Our mission is to unite people, data, and government leaders to help communities thrive through informed decisions and to improve overall resident quality of life. We provide tools that empower resident voices, visualize community metrics, and support strategic planning, budgeting, and performance tracking. NRC, that I mentioned that I started with 21 years ago, is now the research arm at Polko, which is more of a technology company. So we've worked with hundreds of jurisdictions across the country for more than 30 years. The National Community Survey is something that developed out of all of this work we've done across the country. So it's a standardized, comprehensive 5-page survey. It's used to assess resident opinion about the community and their local government. The survey questions, they're categorized into these 10 facets of livability that you see here. And so that's meant to give you a holistic picture of Pitkin County from the perspective of residents. The facets were identified as the most impactful on quality of community life. So most commonly, jurisdictions use this survey data to monitor trends in of resident opinion over time, inform budgeting processes and strategic plans, just assess community needs in general, and then improve communication or provide education where you see gaps. So this is a perception survey. Sometimes you might say, well, why do people think that? And it might be about your services, and it might just be about people not having awareness of what you're providing or how it's being provided. So that helps measure impacts of your policies and your programs as you go along as well. So I'm going to spend a little more time on this slide. It's just because how a survey is conducted really matters. And we use our expertise to ensure that your data is statistically valid and reliable. This was the first time that Pitkin County did the National Community Survey, but as Alycin mentioned, it's not the first time you've surveyed at all. So for the NCS to select survey participants, we purchase a list of all of the U.S. Postal Service residential units in all the zip codes that are related to Pitkin County, and then we actually geocode everyone and make sure they're in your district, and then we also map where they are, because we did track 6 BoCC districts as well. So then we select randomly 5 districts, thank you. We randomly selected 5,000 residents from that U.S. Postal Service list. They received 2 mailings, a postcard that invited them to an online survey, and then that was followed up by a paper survey in case they prefer to do that on paper. The survey was provided in both English and Spanish. Overall, 550 surveys were returned, and that results in a margin of error of 4.2%, which is great for this type of survey. 5% is really our target on that. So that margin of error, if you don't know much about that, just gives you a sense of the precision. So that means if you did this process multiple times, then 95% of the time your results would become within 4.2% of that. So the results were also weighted to the census to adjust for over-response by certain demographics. Older folks always respond more than younger is the most obvious one. And then in addition to the random sample that I just spoke about, an online version was also shared with residents who weren't selected, and that was it was open for 2 weeks in April, and you received 124 responses. We're not going to speak about those 124 in this presentation, but those are online in your report. So we'll just focus on those 550 responses from the randomly selected sample. So one key benefit of the National Community Survey is that you can compare residents' ratings from your community to communities across the country. These benchmark comparisons help show how local services and community characteristics perform relative to other communities in our database. Our national database has about 400 communities, and Pitkin County, so we're going to share comparisons to that national benchmark. And then Pitkin County also is receiving comparisons to a custom benchmark cohort. And that's a similar group of communities, about 20 other resort communities in the Mountain West. That includes communities like Telluride, Steamboat, Frisco, and Estes Park, among others. So diving into the survey results, note again that there's a lot of information on that report, especially that interactive report online. So we'll just get to some highlights. So in the survey, we asked 2 questions about the 10 facets of community livability that I mentioned earlier. And the first question just asks folks to rate the quality of each area overall. And to orient you to the charts on this, in this presentation, question scales were generally on a 4-point scale with excellent, good, fair, or poor. But for ease of comparison and for presentation, we're just showing the percent excellent or good here. Additionally, those bars are shaded, and the darker shades in the bars indicate that it's higher than the national benchmark. The little arrows at the side there are the comparisons to that Mountain West resort benchmark. So here you can see that the highest rated areas were natural environment, parks and recreation, safety, education, arts, and culture. Note that all the facets received good ratings by a majority of respondents, and most of the facets were above the national benchmark, and many were also above the Mountain West benchmark. So these are really great results. The second question asks about these same facets of livability, but it's centered on how important residents think for the community to focus on it in the coming 2 years. So here you're going to see that everything was important to 2/3 or more of your residents. Mobility, economy, and natural environment emerged as top priorities. Education, arts, and culture, safety, and community design were less prioritized for the next 2 years. Compared to the national benchmarks, safety was less likely than other communities to be thought as a priority, and that's likely probably because it's safe. And so they're not, that focus for the next 2 years is not as important. Otherwise, these priorities were pretty similar to the Mountain West communities. Mobility was a little bit more likely to be mentioned than the national. So we ask about that quality and then the importance so that we can look at a comparison and see basically next, like if there's any imbalance. So this chart is also included in the report, and we mostly are looking here for things that are relatively higher importance and maybe lower quality to residents. Here you can see that economy is the only larger gap where people rated higher in importance than in quality. So generally speaking, when I'm talking to different communities, there's quite a few that will be quite a few more gaps. And when we look at, like, for instance, the parks and recreation, in that case, the quality is very high and the importance is slightly lower. So that's not one that we would point to as concern. So economy is really the only one here that this analysis would point to as a concern. So of the 118 survey items that residents provide evaluative ratings on, 32 of them received higher ratings than the national benchmark, 71 received similar ratings, and 15 received lower ratings. Ratings are considered similar if they're within 10 points, and then higher or lower if they're more than 10 points. Higher were generally related to natural environment, recreation, and alternative transportation, and lower were related to affordability, housing, and traffic or parking. As I mentioned, you also have a custom benchmark where you're compared to Mountain West resort communities. And so of those 118 items, 97 were similar, 15 were higher, and 6 were lower. And those higher and lower ratings were similar in category to the ones I just mentioned on the national benchmark. When compared to results from your last survey in 2023, 27 items could be compared. Note that not all of the questions asked this year were exactly the same as last year, but those 27 are roughly comparable. And in the next iteration, you'll have 118 to compare across a trend line. They'll be a little more consistent. So of those 27, 8 were significantly higher than that 2023 survey, 14 were similar, and 5 were lower. Results are considered statistically different if they're 6% or more, or at least 6% different from the past survey. So as you can see here, it was overall economic health, public information services, travel by bicycle, affordability of childcare, school emergency preparedness, high-speed internet access, overall customer service by employees, and police and sheriff services all were higher. It's a pretty mixed bag, not a real theme there. And then lower overall direction Pitkin County is taking, availability of quality mental health care, a value in respecting residents of diverse backgrounds, recycling, and street repair. On to some key findings. So we're going to dig a little deeper on a few of these areas. And again, a lot more detail again in that report. So just to start, life is good in Pitkin County. About 8 in 10 Pitkin residents gave positive ratings to the county as a place to live and the overall quality of life in the county. Residents' commitment to the community also received high marks with over 8 in 10 saying they intend to remain in the county for the next 5 years.
Around 7 and 10 had good marks for the overall image and reputation of the county. And 6 and 10 would recommend living in Pitkin counties to someone who asked, which is similar to the benchmarks. The county is thought to be a very safe place to live, as mentioned before. Nearly all residents reported feeling safe or somewhat safe, very or somewhat safe in the neighborhood during the day. More than 9 and 10 were felt safe from violent and property crime, both of which were higher than the national benchmark, with feelings of safety from property crime also being higher than the custom benchmark. However, only half felt safe from fire, flood, and natural disaster, which is lower than the national benchmark, but is similar to other Mountain West communities. Safety services also received great ratings across the board. Most were similar to the national and custom benchmarks, with fire and EMS topping that list, crime prevention rated higher than both benchmarks, and police sheriff services improving from 2023. Like many communities across the country, residents are seeing challenges related to affordability, and these are certainly amplified in a resort community. More than 9 in 10 residents provided excellent or good reviews to Pitkin County as a place to to visit, a rating that was higher than the national benchmark, but similar to the Mountain West benchmark. About 2/3 of residents were happy with the overall economic health of Pitkin County and Pitkin County as a place to live, or to work, About 6 in 10 residents had good ratings for the overall quality of business and service establishments, but fewer were content with the variety of businesses, a rating that was similar to Mountain West communities and lower than that national average. Finally, half gave excellent or good marks to employment opportunities, which was better than seen in other Mountain West communities. Residents were very concerned about affordability across many categories, with all the ratings being below the national benchmark. However, other than the availability of affordable quality food, the ratings were all similar to Mountain West communities. Note especially that fewer than 1 in 10 provided excellent or good marks to the availability of affordable quality housing and the cost of living in the county. Pitkin County is a very beautiful place, and residents do appreciate your natural environment, but also your parks and recreation systems. Your marks here are off the charts. Almost all were above the national benchmark. Nearly all residents were happy with recreational opportunities and the overall quality of parks and recreation. And these two ratings were higher than seen in other Mountain West communities. Open space, air quality, cleanliness, preservation of natural areas, and water resources also scored very well. Recycling was perceived as good by 2/3 of respondents, and this was below the national benchmark and a drop from 2023.
Interesting.
Residents find walking and biking and using transit easier than getting around in a car. Around 8 in 10 residents had good reviews for the ease of travel by bicycle, walking, and public transportation in the county. Each of these scored above national benchmarks, with bicycle and public transportation above those Mountain West benchmarks. Ratings for vehicular travel in the county were less positive, with around 4 in 10 providing excellent or good ratings for the ease of public parking and ease of travel by car. Traffic flow on major streets was the lowest rated. Each of these final 3 marks scored below national averages, with ease of travel by car and traffic flow also scoring below the Mountain West resort communities. Looking at transportation-related services, most were on par with other communities. However, transit services were above both those benchmarks. Street repair ratings were the lowest, but that is similar to other communities, although it did see a drop from 2023. Residents do feel very connected to their community.
That didn't resonate with most of the people that don't believe we have sidewalks on 250 miles of streets. So, sorry, there was a at the board table. Sorry. We
That's
weren't
okay.
supposed to interrupt, but that's like.
What, the
We don't have
sidewalks?
streetlights or sidewalks that I know of in 250 miles of streets. So,
And we did, I made a note.
I
that
know
says
we,
a
I know we
couple of these.
modified the survey from the national, but this doesn't
fact,
seem to apply.
We kept in a lot of general items from the national, even knowing that we didn't provide the services. And there was a caveat on the survey saying Pitkin County might not be who provides this. We were still curious how a lot of these facets of livability affect our residents, whether we provide the services or not, especially, again, longitudinally. It'd be interesting to see if they go one way or the other. So you will see ratings for things we don't provide. It is an experience of our residents that we were still curious about.
It's confusing.
Because so many of our residents, again, can't separate what the county does and the city does, what's in the county and what's in the city. We get to take credit for all of it.
That's what I was saying. I haven't seen a sidewalk or a street light in 250 miles, but
AABC.
You'll see several services that we don't provide. This is jumping ahead a little
I
bit.
remember commenting on this when it was being created, so I'm just.
Correct. I think as you start to see some demographic changes or demographic separation of some of these items, it's the kind of thing that could suggest programs, policy, partnerships for those who are affected more on things like broadband or good street repair than others in our community, and so it could point towards something that you would prioritize in taking on. Not that you have room on that list right now.
Naju's. I'm just saying Naju left her phone over here.
No,
It
I think,
starts ringing,
yep.
I'm not answering.
Next one, yeah. Yeah, I think, as she mentioned, we, generally speaking, all of our communities, especially counties, they're gonna have different services that aren't necessarily provided by the counties. Same with cities, like the public health services that aren't provided by the cities. But generally speaking, we find it helpful to understand the overall experience. And if people are satisfied with the service, you don't feel like there's, that you provide in abundance, it's likely because they're satisfied with the level of service that you're providing. And going back to community connection, in general, residents gave very high marks here above all the national comparisons for all these items, including opportunities to volunteer, attend cultural and arts and music activities, attend special events and festivals, participating in community matters and social events and activities. Support for the arts and opportunities to volunteer also scored at least 10 points higher than other Mountain West communities. Those were that's an overview of the NCS results, and then we also added a couple extra questions for the county. The first asked residents to select the ways they learned about Pitkin County, the Pitkin County government. Nearly all residents said they used newspapers, while 7 in 10 cited word of mouth as their common ways to get information. About half of all residents selected social media or the county website as a source of information, and 4 in 10 heard about things on the radio. Television, the county newspaper, and other county websites were selected by fewer than 15%. And then finally, residents were asked how they would rate specific aspects of elected county leadership. About half gave excellent or good ratings to the overall effectiveness of the county board, the overall leadership of the BoCC, and the board listening to resident input. There was a bit more concern about the board implementing policies that reflect their values. 3/4 felt the board did at least a fair job, while 24% said this was poor. So to pull it all together, the survey provides a pretty positive story for Pitkin County. Residents rated many quality of life measures highly overall. Safety services in particular came above the national and custom comparison communities. Some affordability measures did score lower than the national average, which lines up with expectations given the cost of living here. On the flip side, residents reported high satisfaction with the natural environment and parks and recreation system and alternative modes of transportation. Things like transit and biking, scored higher than both comparison sets. And overall, residents report strong community connection and participation. It's a community where people feel connected, get around well without a car, enjoy their surroundings,
with affordability being that area to watch. As noted before, there's a lot of more information on your interactive report online. Breakdowns by district and growth areas and also by demographics are included. And also mentioned earlier, Pitkin County can continue engaging residents on Pulco to learn more about the community as outlined today. Over 300 Pitkin County residents already subscribe to Pitkin County on Pulco, creating an opportunity for further feedback, digging deeper on any of these results. And then your subscription also includes a track dashboard that has public data to compare to this resident feedback, and a customer success manager to help Alycin with anything she needs.
You touched on it.
I just think some of them are interesting, like we're one of the top recycling landfills, solid waste centers in the state, and so there's just, it just causes you to question what they were choosing to rate and what they were thinking. So maybe because they don't have door-to-door recycling pickup at their house in Redstone, so they're, yeah.
I think there's two things I would say that. One is that we can look at closer at the districts results and see if there's a differential there.
Yeah, that would be
But
interesting.
the other piece is that I would always say that sometimes when there's a surprising rating, it's good to think about perception versus what you actually provide. I've definitely seen in communities where, like, if you look at the metrics on, say, policing, like how many police officers you have per street or what is the actual crime rates, and they have a lower rating for police, for instance, you might look at, okay, well, why do people perceive this as, was there something in the, is there an education gap? Are people unaware of the service, or in the case of recycling?
Yeah, and the issue of districts, that's a really good point.
Of course.
Yeah, but it's also like the street sidewalks and street lighting. Did those lower numbers come in from people who live in District 1 and 2, which are the city, where there's sidewalks and street lighting? And that's probably what you would find.
And the other piece,
It's really interesting.
there's a don't know option on all of these ratings. So I didn't look at what the percentage were in don't know, but here we just report the opinions of the people who had an opinion. So we're excluding the don't knows from these ratings.
Okay, interesting.
Was there a slide I missed that said here are the facets that we really?
Here's the
Yes.
what?
The facets of livability that we should sort of unpack and say, okay, here's, from a strategic plan standpoint, we're about to go into our 2050
Right.
planning. So how do you take the poll consulting and combine it with what we're about to do adopt in the next couple of weeks in the 2050 plan? So how does this feed into sort of the other $1 million in strategic planning?
Well, I can jump in. The way that we've used this information in the past, and I'll foreshadow a little bit of excitement for you all, is also, I think, as, you know, on an annual basis at the BoCC retreat, you know, are there other priorities? Are there things that we need to be giving attention to? So maybe less in the comprehensive plan, which I think you're referencing, Jeffrey, and more in a strategic planning conversation, even though those two are informing one another. But I think what we've looked at is, you know, really on this matrix of, are there things that are of, you know, high quality and high importance that we're being rated low on that we need to? A really good example that sticks out with me is, I think it was maybe even the 2016 survey is where we really started to identify mental health becoming a huge need in the community, and we started to shift resources there. And so starting to look at it, nothing's maybe on an annual basis, but are there things that we really need to be putting more attention to that we haven't, and or keeping track of, and things are slipping too?
Your gap analysis here is the 10 facets of livability in quality versus importance. The prior two slides are one and then the other, and then this is the difference. So that's where you would see where you're shooting and missing. I did want to point out a couple things I think that we've seen that policy has affected, and probably that back end policy work is what you would use this for more. But I actually think the fact that mobility is lower. It's than national than other mountain regions. But our public transportation and getting around on a bike is higher than, like, almost as high as you could possibly get. That's a policy thing that I think has happened through Pitkin County and partners, where we wanted getting around in your single occupancy vehicle to be your last choice because you had such good infrastructure in all these other ways. So you've seen kind of gripes through this year's results, which is like kind of a check mark. We got the policy worked. You also saw that childcare is better and less important than it was two years ago, 4 years ago, the last two surveys. So I think when you heard that was an issue, there was a lot done to support childcare facilities, childcare tax, stuff with human services. And so to see that that's not as much of a priority, or to see that has gone up, is because of policy. So you get to use these, the gap analysis is general, and then those things under economy specifically, we could look at and say, well, what policies are intertwined that you're working on that you'd be able to measure over time?
I mean, this jumped out at me when I first went through it, this economy in particular is the one big gap. But then later slides have economy like rating pretty high as far as the economic health of the county. And I wondered what you might have thought economy meant in this survey, at least with the gap there, because, you know, I could see it being economy like, yeah, it's job versus affordability. Maybe someone puts that in economy, or even adds general, you know, like, but it seemed like later it said, overall economic health was higher than, you know, the other regions. I don't know if that jumped out at you, or if you even do that assessment yourself, or you just.
When we look at the economy, it is these pieces these ones are more probably like things that you could potentially help influence, of like, is it a good place to visit? Are people coming in? Are you bringing money in? But then I think like people also really think about that affordability side of it. So that we put both of those into economy, and I guess maybe as a broad economy, like it's the economic health of sort of how people are experiencing affordability, plus what you're providing in terms of support for businesses and that. So it's kind of two sides, but we put them both in there, and that's probably, but I would say the affordability problem is really influencing the gap.
Because that's a broad one to try to target. You can target parts of this. I don't know. I love the affordable quality food. I'm not surprised to see that down arrow.
I think we kind of all agree on that one.
Now, I thought it was great. I thought it was actually kind of I didn't see anything jump out at me that was totally by surprise. It seemed kind of more confirmation about things that have been addressed as things that need to continue to be addressed, and other things that are like, clearly we're doing really well on parks and natural landscapes. So maybe, the focus should continue to be on these that showed up here. I didn't see anything that really, apart from the sidewalk thing, which is kind of an outlier more than anything. I thought it was kind of confirmation of maybe the focus is on the right things right now. I don't know.
So, and I think that would be beneficial in looking at priorities, and maybe in the next for 2027, would be for the board to look through and highlight, like recycling, where did those numbers come from? If they came from the city of Aspen, what can we do? If they came from Redstone, we could focus on what we could do for enhancing recycling in Redstone. Same things with sidewalks and streetlights. So any of those where we could fine tune and get where the numbers came from would help us. And I don't know if sharing that with the city of Aspen, to say we had a lot of numbers come in about streets and sidewalks that were from people who live in Districts 1 and District 2 of the county, which is mostly the city, and maybe share that with the city, just so we can, maybe they can learn from what we're learning. But I think for the county, there's some things I think that the board could look at and say, I'd like to know where the numbers came from on this issue, if we're gonna look at priorities for 27.
Street repair too, that was another one that was kind of low.
Yeah, are they living in the city, or are they living in outliers like Thomasville or
or
Yeah,
the
okay.
highway.
Yeah, that would be really helpful, so we can really know where we really need to focus our energies and our money. So you need to know where you're gonna focus your energies and money.
I know.
Is it-
To respond to you, Ted, 67% did say the economy was good. It's just that 85% said it was a priority.
Right.
So it was a high gap, and that's why the gap analysis is a little funny. Does our worst thing, we were 2/3 think we're great at it, right?
Yeah.
To Patty's point, the next step for me personally is to go to all the directors and get that very granular information. So OST with our parks and rec, the landfill with the recycling, public works with street repair, and really show that. I would also love to meet with each of you. We can show you your district, but also we were able to on the back end identify urban growth boundary residences versus in our rural. So a more general kind of gap of the services you experience. You probably have a municipality that's also providing or hindering some of these experiences. What we did to make it more confusing for our public this year was use the exact same provider to do a community service months apart from the city of Aspen conducting this exact survey.
Right.
So their results are coming out, which is convenient for us to do some of these comparisons
Yeah.
within the next month or two. We will get off that cycle and cause a little less confusion, hopefully, and probably with your guidance as to some of that pacing moving forward, but that's the way it worked out here. So yes, our districts, we also had them select a town, self-select, and we'll get to compare with Aspen's data, which is,
That'd be good.
yeah.
Because, you know, with our limited resources and staff time, we really need to really fine tune those priorities.
Is there one more? Can you go into just how you weight things to control for demographics and stuff? Because if you have, it was like 11% people replied. And you could see in some of the open-ended comments, you know, some people were clearly fired up to reply because they had a lot of things to say. And so if you get biases there and you want to know, I just want to be curious how you can control for that, if you can share that.
So the main thing we do is have that random sample. So I think in any research or public input, you're always going to have a slight bias, at least towards folks who are more engaged. But with the random sample, you're sending it out to folks who aren't like interacting with the community, with the county regularly. So the random sample, that's the first part for sure. And then the second part we do with the weighting, that is just really adjusting for whether like older versus younger,
Okay.
renters versus homeowners, because homeowners also are more likely to respond. So we just balance that back out statistically. So
Okay.
if we heard, you know, from 20%, if renters are 20% and we heard from 10%, we make them worth 20% in our responses statistically.
Okay.
So that's what we're doing there on the back end. You can't really adjust for engaged versus not because we just don't know. But generally speaking, it is feels like a lower response rate. Having 550 people is really great. That's a good amount of folks in your community. Response rates overall have been falling for the last 20 years. And Pew has done research center has done a lot of good research on response rate and how that impacts the validity of or representativity. And basically have found that if you continue to do a good random sample, the results are still representative. And they've done studies where they basically they ask a question that is also asked on some larger studies that have very big budgets to try and boost the response rates that get into the 40 to 50% response rate. And they've found that the results from a well-done study that has like a 10 to 15% response rate have the same results as one that has a 50%. Always want to have more. I mean, we always try and encourage getting the word out to try and increase those response
Statistics
rates.
major, are you?
Yeah, you want me to
Yeah,
dive
you want to
in?
chime in here?
I was trying not to, but thank you for the opportunity, Commissioner. I think a couple things that we've done over the years. Well, one, 550, it's 50 more than we typically have gotten. So by going to Polko, we used to just stop at 500, and I think now we're trying to continue to increase that. So I will say 50 more is even better. And what we started to do a couple of years ago too is complement the statistically valid with the open-ended for those that want to. I think kind of to the same point of how far off are we seeing, like, is the statistically valid, are we missing pieces? The other part is, we wanted to make sure we are capturing maybe more of the workforce that doesn't live here or might not be getting it. And are we off the mark between those two surveys? And so far we really haven't been. So I think it's helpful to see of, like, as we kind of add this more in, stack a few different layers rather than just the statistically valid, but I love to hear that. And I also think it's important to continue that part of it too, right? Because people will self-select sometimes.
And
Did we talk about confidence intervals or anything for fun? Just kidding.
Any takeaways from the Mountain West, sort of I'll leave it at that. The Mountain West comparison versus national, so versus our peer group.
One thing that that struck me the most, just as far as where we came in higher or lower, was that availability of jobs.
Yeah.
I think, and then worse at traffic. So those were the two that were most striking to me. I think that, like you said, not a lot surprised us who are experienced with the community, but it's good to have the validation. And so I think just having a strong job market, I think that also speaks to the economy, that your background and what you do, we're not solely hospitality based. There's a lot of opportunity for a lot of different types of jobs. So that one was the most remarkable to me.
So you're saying higher for availability of jobs, lower for traffic. Go to any mountain resort in this community, in our region, traffic, it sucks anywhere you go. It's bad across the board.
Well, and I think you have to
anywhere in the
use
country, actually. It's,
Yeah.
yeah.
I just feel
That's
so lucky
interesting.
that we have, you can bike to every mountain. I just don't think a lot of mountain resorts have that option
Yeah.
from your condo to the hill on a bike.
Yeah,
for
I would say
instance.
that that's the big difference, right? You have like a really strong alternative transportation, as opposed to most have trouble with traffic and parking.
Yeah.
If you have a lot of
Anywhere you
visitors,
go.
that's how it works. But you have a lot stronger in terms of the alternative transportation.
So takeaways for what you would do differently in 2 years?
I like that we now know, I guess, where we've kind of undersampled. I like this conversation about, since we're not just stopping the minute we get to 500, let's see how many we can get. I'm really excited for the longitudinal that will come in 2 years, so I would not change too much as far as that would compromise that.
I think there was one we had talked earlier about, in that open participation one, we had asked if they're in the district or not, in which district they're in or not in the county. And I think we're talking about having a follow-up question to understand better if it's, if you're not in the county, why are you doing the survey?
Right.
Which is like, you live right next door, you're on the boundary, you have family here, you work here, you recreate here, you shop here. So I think that would be an important question to add.
Any suggestions on your part?
I mean, I'll go do my own homework. I mean, I'd like to hear more in the Mountain West.
Okay.
I think, again, that smaller cohort, if you will,
Yeah.
versus the national. I'm not
Oh,
as
yeah,
concerned
of
about the
course, yeah.
national. I think it's a unique.
And your
More comparison relativity.
Yeah, I mean, yeah.
Yeah, the supplemental booklet in your packet is that comparison just with the Mountain West, and it lists the 20 communities, which may or may not be helpful as well. It also shows how we've weighted, so I think we got 5% of like 18 to 20, and so in order to get that to 22%, which is our actual population, we had to add that extra 15% essentially. So you can see some of that math, but that's a really quick look with these triangles, like
Right.
very quickly visual. I would love to sit down and do
That'd be great.
the data with you guys.
Yeah. I'll bring my statistician.
No, don't.
AI.
Yeah, I just think it's, I love doing these surveys myself, so I'm glad to see that a large member of our constituents like doing them also.
Anything else? Linear regression, coefficients, anything else? Correlation
Excuse me?
Well,
coefficients.
one thing, is it possible on these questions, I've seen it, we've done other surveys where the actual question can have the open-ended comments on it, so when we have these ones that we're asking about streets or,
Generally speaking, we try and limit the number of open-ended because it's just a lot more onerous on folks to do the survey. I mean, if,
Yeah.
it- and
optional? I don't know.
just
Makes
the
it
typing
too
in.
long.
Okay. Just
And
for
the other
yeah.
thing is, I do think the open-ended, all the open-endeds can give you some color and context, but I would always warn against really honing in too much on them because they're not representative, right? Like, maybe I didn't actually look, but generally speaking, we're getting 20 to 40% at most who are giving a comment. So I think it's easy sometimes to be like, oh, I saw this 5 times in these 30 comments, but like, okay, think of it as 5 and 550, not 5 and 30, right? And it's still context. It still can be really helpful, like to think about like, okay, maybe 20% had a negative rating for this. And then when you look at the comments, and it gives you some color on what folks with a negative rating on something might think, where they're coming from in terms of a little deeper dive on the services. But I would always just think of it as color commentary and context as opposed to representativity.
Well, and some of those random ones showed you that people were confused.
Yeah.
So it's hugely helpful for a comms department, right, to even be clarifying what we're responsible and what we aren't. I mean, I think we have a lot we can take away from this. Can you remind me, I don't think the open-ended is an option on NCS. We chose to include that.
Yeah, you chose to include
That was
that.
us asking. It's not, most communities who do this survey don't have an open-ended opportunity, and we wanted to hear.
It's interesting to see what people
Yeah.
say
Yeah, I agree, but.
in fine print.
We'll blow that up.
With our
That's what I'll do
caveats.
differently.
I think that speaks to the one point I would call out in the Mountain District, even national, is, as you all know, I think the much higher and higher level of engagement from community members, which I think is, it's sometimes it takes a lot to get things done here, but I think it's something to still really continue to lean into. I mean, I think it was the percentage even compared to the mountain districts is that we have a very engaged population here that engages in the local public meetings,
Yeah.
which is something to never
Like
lose
3
sight
rooms
of.
full of commenters the other day.
Were you, from a marketing standpoint, were you surprised by the overwhelming response to print?
No, and that custom question we left in because we have asked it so
Right.
many times prior. It's a little chicken and the egg. If that's where we're putting the information,
Right.
of course, that's where you found the most information. But I think it's a very helpful, and what we've seen here that is effective. The word of mouth from a marketing perspective, that stops my heart, of course.
Right.
If their word of mouth is coming from because they learned correct facts from the newspaper or press releases, fine. It's that, how are we stopping the tableside conversations that lead to misinformation that we'll continue to work on day in and day out? And I think meeting people where they're at is what I'm looking to Abby, because you're welcome to speak to it too, is our goal.
Yeah, another thing I was going to say is probably the age range that responded to the actual survey also correlates with their method of media.
When I looked through age and income, it was very interesting to see lower income reported contacting their local representatives more. Higher income reported watching a meeting more. So just like who's
Interesting.
willing to contact you versus who's staying involved. This isn't that surprising, but rural would watch through grassroots or other channels more, whereas urban were more likely to attend a meeting. So, things like that kind of start to shake out and are funny. The thing that I chuckled at the most was the number of people who anticipate living here over the next 5 years, astronomically high. The number of people who would recommend living here is low. And so
I know, that was interesting. You know what
are
it
we-
is? They don't want more people living there.
So you
That
learn
one
little
was pretty
things about our
clever, maybe.
personality through the cross comparison of some of the questions. And
I love living here. I don't want anybody
yeah,
else to live here.
there's part of that going on, and knowing it's hard perhaps, and so not wanting to tell your loved ones to jump in and make it work. But I think there was a little bit of things that were rated lower out of self-interest, perhaps.
Thank you for your time.
Thank you. I can't wait to
thank
go
you.
into
Thank
it more.
you, Allison.
Thanks.
Grassroots, we're going to go read the paper. We're on break.
I'm going to listen.
Good afternoon. It is Tuesday, August the 18th. It's 3 p.m. Some of us are skiing, some of us are dealing with water, and the rest of us are here. So welcome, Andrew and Carlin. Some of us are skiing this week. It's a powder day somewhere. So welcome. We're here.
Oh, that's skiing.
What? Sorry, we're picking on other commissioners who are not here, but they're about to watch this, so they will see this when they come back from their ski holiday.
And you will
Andrew
hear about it.
and Carlin, welcome.
It's all good.
It's with a K. It's what's throwing me off, and a Y. And Nicole, the table's yours.
Thank you. Thank you, Chair. Yes, my name is Nicole Rebeck-Stout. We're here to present the STR impact study. I'm joined by our EPS team, who you already are familiar with, Andrew and Carlin. I also want to point out other staff who have contributed to this project: Suzanne, Alex, Sam, and not here today, but here in spirit, Jeanette Musio. She contributed to this report as well. So we are here to present this report. We would like to get through our slide deck. It should take about 30 minutes. All the slides have page numbers if you have questions. We'd prefer to save them for the second half of the hour. And then, as was indicated in the memo, staff's really looking for direction from the board to bring forth an ordinance with code amendments to reflect what's in this report. So without delay, I'd like to just pass it over to EPS.
All right.
Yeah.
Thank you, Nicole. And we're happy to be here. Enjoy working on this project with this team. It's been great. And looking forward to presenting today. Just by way of background for anyone who might be tapping into this remotely, Economic and Planning Systems, the firm has been around for 40 years, the Denver office for 25. Over that time period, EPS has been very active in communities, very much like Pitkin County, from Montana to New Mexico, active clients, and we've done a lot of work in the Roaring Fork. We've also done a fair amount of work on STRs throughout the Rocky Mountain West, and are happy to bring that expertise to the issues today. What we are wanting to do in terms of an agenda for today is review the project, and then divide the analysis of the presentation, really the bulk of the analysis, into positive impacts and corresponding recommendations and negative impacts. Sometimes short-term rentals are lumped into one bucket depending on who you happen to be talking to, and it's either all good or all bad. The truth of the matter is there's both, and we want to talk about both and ultimately recommend policy to maximize and amplify the benefits and minimize the negative impacts. And then we'll wrap up with a discussion. So we also have just about a half dozen slides on the existing conditions. The Pitkin County SDR context, there are about 73 SDRs in the unincorporated county. There are more SDRs within the city of Aspen, within the town of Snowmass Village, and within Basalt, 73 in the unincorporated area. The current standards effectively limit the growth in SDRs because it requires a prior rental history from 2017 to 2022. That's an important part of the context that we're going to be talking more about here shortly. There are three distinct market segments, and we've got a slide on this, but it was interesting for us to see just how high the room night went. We did quite a bit of research, testing 3 different seasons: winter high market, summer high market, and midwinter low market. And one of them went as high as $60,000 a night. We do have an analysis of the fiscal implications, and Pitkin County has fewer SDRs and lower taxes and lower revenues than peer communities. Notwithstanding the small number of SDRs, there are ultimately $14.3 million in bookings and expenditures that occur from the SDRs that are booked. So little bit more on the background. These 73 units, you can see the locations here, concentrated in the urban growth boundary and along Highway 82. These are the market segments, and we've broken it down into low, medium, and high. That low is generally up to $1,500 a night. The medium goes from $1,500 up to $10,000 a night. And you can see in these red circles just the extent of how many are represented in the middle of the market. The high end goes from $10,000, and on this chart up to $25,000. We do have outliers with a handful that go as high as $60,000 a night. This represents summer peak, winter peak. One interesting thing, summer peak is more expensive. So, we've seen this in other markets too. Telluride, for example, the summer season outpaced the winter in terms of occupancy and room nights and room rates. So that's certainly true in this market. Peer communities, you can see that Breckenridge comes out at the top with 41, almost 4,200 STRs in their community. Minturn, the small little town between Vail and Avon, 30. Pitkin County, a large geography, a relatively small number of STRs. So, which shows that the current limitation, there's not been a proliferation of STRs in Pitkin County, in part because the existing regulations have been effective in keeping a lid on the total. This slide, also interesting. This looks at the tax revenues that are generated through STRs across all of the various destination resorts, if you will, or destination markets throughout Colorado. You can see that there's quite a few in the middle that range between 12 up to 14% taxes. Aspen is near the high end with 22.3%. Ouray, very high end, 28%. They didn't mess around when they adopted their policies. The three different, the composition of these revenues include sales tax, which is shown in blue. It's inclusive of all taxes like sales tax. Then a specific lodging tax shown in tan, and then an STR excise tax shown in brown. And we have Pitkin County. We will be revisiting this down the line in this presentation, but we are at 6.9%. Which is the lowest of all of the peers that we found data available for. Revenue generation, you can see here that the STR sales tax revenue, specifically just over $500,000, Pitkin County picks this up in the form of sales taxes applied to STR activity. When you look at guest spending, that 3.6% sales tax rate translates to $14 million in the dollars spent on STRs. That is on the lodging itself. It does not include all of the dollars spent in the community, in recreation, in guides, in retail, in restaurants, what have you.
We just wanted to share a couple of the highlights of the community engagement work that we did, which included surveys both for community members and for STR operators, as well as 2 focus groups that were conducted up here in December. And there's an appendix on this slide deck that has the more detailed findings of our community outreach, but you can see some of the highlights here, where people understand that short-term rentals are an important part of this community, it's an important part of this economy, and that they want that to continue. And also, there are concerns that community members have. These include traffic, disruption, and taxing on natural resources, particularly with respect to water and fire. And we feel very lucky that we were able to hear from the community and incorporate these findings into the report to be able to add a little bit more of the qualitative element to this quantitative data.
So in terms of the framework for the study, this next slide, there's a lot of information on it, but it provides the framework for today's presentation and the whole analysis. The upper part of the slide, I'm just going to talk about how it's organized. Upper part of the slide, high intensity impacts. Lower part are the limited intensity impacts. We've got a left column that addresses how we ranked them today. We've got a future column in terms of how they are likely to perform with the adoption of the recommended policies. And then the last part of 2 other parts, one is the carrots you can see that the number and direction of the caret shows the degree of impact. Green is high impact is positive. The tan or orange is a negative impacts that need to be managed as best possible. And the number of carets show the degree of impact. The final part is the tan text on the right side. Each issue not only has this analysis, but also has a recommendation. And this is a summary of where we're headed. And we've got plenty of material in the rest of the slide deck that will move into each one of these.
Before we start to go through each of the recommendations in detail, we wanted to start off with the big picture and introduce the 3 proposed license types that have emerged from the various research that we've done on the STR impacts. So in this table, you can see on the left-hand side are the 3 existing license types, your seasonal, seasonal limited, and otherwise limited. These are differentiated based on the number of rental nights per year. After assessing the different impacts and discussing the best ways to support the positive impacts and mitigate the negative impacts, what we've landed on is this framework with 3 license types, where type 1 is a general license that can be open to anyone, maximum of 120 nights per year. We have removed the requirement that currently exists of having had a rental between 2017 and 2022, and we'll get into more details on this later in the presentation, and instead replaced with the idea of a geographic cap, capping the number of STRs by area of the county. The type 2 license is meant to be a very low intensity, low barrier license type to allow certain community members to rent their property more easily and benefit from the revenue that that property can bring in. And the last license type here, STRR, takes the existing Redstone regulations and moves forward with them. So each of these will be explained in more depth throughout this presentation, but we wanted to show this framework from the start so that you're able to locate yourself throughout the rest of the presentation as we use some of these terms. All right, so we'll start with the positive impacts. We'll go through each of the impacts that we saw on the slide that Andrew just described. Each of the subsequent slides, or actually, you should go over this, sorry, I was getting ahead of myself.
No, you're good. I mean, we're going to start with these 5. They're the ones noted in green, and these are the ways STRs positively benefit Pitkin County.
So what I was going to say is that each of the subsequent slides now is going to be formatted just like this, where you've got upper left is the impact, which corresponds with these impacts listed on this table. The upper right is going to be the policy recommendation that we've worked with to either support the impact if it's a positive or mitigate it if it's a negative. And then this critical success factor listed across the bottom is how we're going to measure to really know if this policy has been a success as we continue to monitor the program over time. So we're going to start off with this first positive impact, which is that STR income can support local owners. We heard throughout our community outreach that families that have been owners in the county for generations, the STR income allows them to upkeep their home, it allows them to make improvements and to remain in the valley when they might have otherwise been displaced. This is a benefit that we think is important and strengthens the county and should be continued. And as a result, we propose the STR Type 2 license, which I just described previously, but it's mentioned here again. This is a low-intensity license type that's meant to be accessible to what we're calling qualified owners. Qualified owners is determined based on criteria from other locations, including APCHA, the City of Aspen's owner-occupied license type, and standards in Summit County that dictate for people who are owners in Pitkin County and working in the Roaring Fork Valley that you're able to apply for this license type, rent your property for 30 nights or fewer per year, and have a lower permit fee to allow you to access that permit more easily and monetize your property to be able to use that income to help you avoid displacement. A little bit more on the application fee. So as I said, the Type 2 license has a $200 fee, which is meant to be a very low barrier to entry. The other types, general, which is the type open to everyone, has a $400 per unit fee, as well as $200 per bedroom. And that's a common practice across peer communities that allows you to scale to account for the greater impacts or the greater difficulties in management that larger units may have. So more staff time could be spent on larger units, therefore the administrative fee is higher. And as you can see in the table on the right here, the fee revenue for the program has been calibrated to match up with the approximate program expenses so that this fee will ensure that the STR program can stay in fiscal balance and really pay for itself. If the program expands in the future, there are more STRs, this program, the fees can expand as well, so it can remain balanced fiscally.
And just to highlight, this is a difference from what we have today. Today it's based on a percentage of property value. So the actual fee burden to individual applicants will be going down.
Mm-hmm. All right. The next positive impact we want to get into has to do with Redstone, where currently there are unique regulations in Redstone, where across most existing STR license types, there's a 4-night minimum stay. In Redstone, currently that minimum is 2 nights. Similarly, there's 120-night maximum rental nights per year. In Redstone, that's moved up to 180, and that's just because the current bed base in Redstone is very small. There needs to be a greater lodging pool available in that area. And we found that these policies have been very effective. They allow guests to visit Redstone and spread economic development into that area of the county. So we recommend that this existing policy should be maintained in the form of the STR-R type license. You can see that 180 maximum nights per year and the 2-night minimum rental period are encapsulated in this STR-R type, and it has the same license fee structure with $400 per unit with the additional $200 per bedroom. The next positive impact that we want to go through is rural conservation. Currently, STRs are not permitted in the most rural and remote areas of the county, and we commend this. I think it's done a great job to prevent excess development in backcountry areas of the county, and we think that this policy should be continued.
Another way to view the short-term rental inventory is that it expands the type of lodging options and expands the overall county's bed base. Different guests they want to be either in the heart of the action, right in, for example, Aspen. Other guests want to be on the periphery. There's a variety of price points, and some, in fact, get quite strong on the periphery, bringing those guests into the county and into the county's economy. The ability to diversify lodging types on the whole is helpful to the industry. Also, there's expanded economic benefit. The sales that are generated and the guests that visit Pitkin County ultimately flow right to many of the merchants that have operations going on locally. We did some outreach to various operators, and they described a guest profile that in some cases the wallets that they bring with them are quite sizable, and those dollars that they spend here are also quite sizable. So it's just an important part. We don't think that anything needs to be modified in terms of recommendations. You can see there the policy is to continue. But in the overall conversation about STRs, this is an important element of what they provide. Now we're moving into the negative impacts that with more specificity in terms of recommended changes. And you can see here, these are the orange or brown policies or elements of the program. And you can see that the degree is shown there by caret. And as we want to move from the current to the future, we've got fewer carets pointing down with the recommended policies. There are negative impacts that any guest brings to a community, and we recognize that. They're also positive. On the whole, we think that the program will be balanced nicely with the recommendations that we are moving through.
All right, so we want to start with a really big one that I'm sure that you all have probably heard about before, which is concerns about community character. And when we began this study, we really expected to hear a lot of pushback, a lot of concern that STRs are ruining the neighborhood, STRs are really causing a lot of disruption. That's actually not something that we heard a lot of. So in the survey data, 51% of people reported that they didn't notice STR activity in the county. And when asked about their specific neighborhood, only 18% of people said that they notice it. On a scale of 1 to 5, only 18% were either 4s or 5s of noticing it really highly. And so what this tells us is that current requirement in place, the 2017 through 2022 rental history, has kept a lid on the number of STRs in the county, and as such has prevented the proliferation of STRs that would really cause this harm to community character. And you want to commend staff and the BoCC as well for having kept the lid on that activity so far. As we discussed, there is a trade-off of having that 2017 to 2022 requirement, where if you didn't operate an STR during that time, you're left out of the program. And we want to be able to make sure that in the future, people who do want to monetize their property in this way, or as we said, with resident homeowners who need that income to keep up their property, we want to make sure the door can be open for them. So we do propose removing that 2017 through 2022 requirement and instead moving to a system where the number of STRs is still limited, but it's limited with a specific number cap in each geographic area. So you can see here this map. It's a map of the county developed through the Vision 2050 Comprehensive Planning Update. And it just is a spectrum from the most rural and remote areas up to urban. And within this, we've overlaid the master plan areas, and really the system is going to be in areas that are more rural and remote. There's a recommendation for fewer total STRs versus in areas that are more developed, have more services for guests, more emergency services if anything were to happen, that it's more appropriate to have STR activity take place there. So we're guiding STR activity towards the more appropriate areas of the county while still maintaining a lid on the total amount of STR activity overall. And within the report, there's a table 11 that lists each of the MPAs and the corresponding kind of high, medium, or low amount of STRs that is recommended. Overall, this shift in policy is not expected to increase the total number of STRs in the county by very much at all.
Another tricky part of the conversation is around real estate speculation. When we've been here working in the Roaring Fork and some other jurisdictions, there was discussions, informal discussions, but a concern that Warren Buffett had put together a fund purchasing high-end homes and then creating the acquisition and the revenue stream accordingly to create a return for the investors. We never found that to be true. However, even on a smaller scale, there are investors that will acquire a home because the NOI, the net operating income, can be substantial. How do you prevent real estate speculation? And we think rather than go with the historic performance of having a license, a more effective way to do it that broadens the number of applicants that can participate and directs the location to where they are best located within the county in terms of where the services are and where the community can accommodate them, is to move into a lottery. So will be a cap by MPA, and as availability occurs within that MPA, applicants can apply for, and then staff will run either on a quarterly basis or biannual. That's a detail we need to refine, a lottery for that jurisdiction, and then applicants are awarded, and then verification proceeds. But there is and then also, once you have your license, you can keep it in perpetuity. You don't need to re-participate. We think that this takes all the wind out of the sails of anyone who's trying to speculate with an STR. And it's very effective in terms of terminating that speculative process and at the same time broadening the participation. So it's kind of a win-win in terms of both of those categories. We also have, and this is probably the issue that drives most of the policy conversation with most of the communities that are grappling with STRs. There are a fair amount of workforce, employees needed to run these operations. And not only is it the cleaning crews that are there on site, landscaping, snowplow, all of that, but in some communities, in Pitkin County particularly, some of the services that are requested can get fairly esoteric. All of this to say, there's a lot of housing, there are a lot of workers required to maintain the operations and a corresponding impact to the housing supply. So various communities have ultimately found ways to generate revenues to offset this impact and fund an expanded housing program. Different communities have different approaches. We saw that at the very beginning in terms of different types of taxes or fees. The lodging tax is the best tool aligned to Pitkin County, and we would recommend the county proceed with that. It does require an election, but it is one that we think would be worthwhile, particularly given where Pitkin County is relative to its peers and relative to its closest peer, Aspen. I mean, essentially the bottom and second from the top in terms of the whole spectrum of what all of the resort communities like Aspen are like in this region are performing. So that is one of the recommendations that ties directly into revenue generation. There are the state does allow counties to charge lodging tax. That's a recent change. You can see there in this bullet, Uray, Route, Park, Gilpin passed taxes in 2025, and now those are charged, now they are charging 6% on their lodging inventory. If this were adopted in Pitkin County, you can see the current base of expenditure, and that applied to either a 2%, 4%, or 6% lodging tax results in revenues somewhere between 300 up to 860 at the highest level that would be allowed. That would be dedicated for either, it has to be dedicated per state statute for housing, childcare, marketing, or transportation, and we would think that it would be best, the county would be best served if it were dedicated to housing. We also found in our research that there are part of the inventory that are leased for more than 30 days. And in some cases, we think that these, given the opportunity, they will come into compliance. They will pick up a license, and they will not only comply with all of the standards that we're talking about, but they will also charge sales tax and potentially lodging tax and have those revenues come to Pitkin County. Some of them, it's really a market issue, and they've got a market for very wealthy clients that might rent it for 4 weeks, 8 weeks, a summer. In other cases, they really actually have they have less than, in some cases we think there's some violators that need to be brought into the program and can, if there's an opportunity for them to do that.
All right. The next few slides here are about things that are not currently very strongly negative impacts, but if not properly regulated, could get out of hand. And these are just ways to bring Pitkin County into alignment kind of with best practice and with things that other peer communities are doing. So one of the big things that we heard in community outreach was concern about water, particularly well water and shared wells. If your property shares a well with an STR property, how do you know that they're not going to overly use your water resources? So the recommendation here is to update the application requirements, where if you're applying for your STR license, just submitting proof that your well capacity is sufficient for your STR guests, your hot tub, et cetera, et cetera. This is in alignment with Summit County and a few other peer communities. Similarly, if your property is on septic, just submitting proof of recent inspection for that septic system to ensure that STR guest usage wouldn't cause damage to that system and wouldn't potentially cause environmental harm. And then lastly, with wildfire, guests visiting the county might not be familiar with wildfire risk, with wildfire best practices, and currently there is information shared with guests about fire safety, but we can even go one step further, especially in a summer like this where fire conditions are so severe, and implement new code requirements requiring defensible space to be cleared around the STR property, and then just to show that with photographic proof, which will allow us to know that our STR properties are just a little bit more protected from wildfire and to mitigate that risk. Lastly, there's a whole category of kind of other standards of things that should continue to be monitored and mitigated against. So this includes things like trash, noise, that the Good Neighbor Guide, which is currently distributed into every STR property, it's required to be on display and available to guests, has requirements for things like quiet hours, how to properly dispose of your trash to avoid wildlife, things like that. And we recommend that that continue. We think that that's been well regulated because we haven't heard a huge number of concerns about that as part of the outreach. Traffic and parking was another big concern that we expected to hear quite a bit about from STRs. We actually worked with another firm to do a study on the traffic implications of STR guests and found that on the top end, STRs contribute about 1% of daily traffic on Highway 82, which is a very small amount, and that is largely, it's very related to work that was done for the Vision 2050 study in terms of the traffic implications of homes of different sizes. That work was applied to STR guests and properties that are at times vacant, at other times have additional guest activity. Either way, the takeaway was that STRs are really contributing a very small amount to the overall traffic that's occurring within the county.
So that, we've just got a couple more slides to frame up the discussion, but that covers the analysis of all of the elements, both positive and negative, in terms of the intensity generated by STRs. This is our summary slide. We've used it as we've moved through the presentation and have used it as in the report also. It's a way that encapsulates everything going on, including the recommendations. And we can come back to this if you've got specific questions. The last slide is 11 topics that we'd appreciate hearing back from the BoCC in terms of direction related to all of these different impacts and how to best manage them. So with that, we are done with our presentation. Staff, anything you'd like to add, Nicole or others?
No, I think this was a really a good 30-minute summary of the report. Obviously, we could have spent more time presenting it because there's a lot of detail in the report. But I noticed a lot of notes being taken, so I'd love to launch into commissioner discussion.
I'm going to start off with a very basic question. I thought right now it was legal within the state of Colorado to do 30 days plus one. So how would we make them require an STR license when they can already do that? Is that legal for us to do that?
You are correct, and it's more of we think that there are some that might be that would prefer to operate with shorter term rents, and would come into the program. Now, you're right. The state, if it's 30 plus one,
We don't have any control.
yeah, right. It's more of offering that opportunity for them to come in.
Why would they want to do that if they can do it without having to go through our process?
I think that there are some that are targeting a shorter stay, but then they're not
Reporting it as a 30 plus one day. We're aware of that, but and how they do it, it's a loophole. But yeah, I just don't know how that would work.
I think we know that people are using that as a loophole, right? And I think what Andrew and team are suggesting here is those that are using it as a loophole would probably be incentivized if they were doing 2 2-week rentals versus 1 2-week rental a month, that they would likely come into the system because they would have
So that
more
would open up
frequency.
more residences to short-term rentals, which I'm not sure I'm supporting. So that's a broader question for me. I think the reason that we had the historic use was to maintain that limit so that neighbors were prepared for, okay, they've already been using it as a short-term rental. And now if we open that up, neighbors might not be prepared for more short-term rentals in their neighborhood. Be they 2 weeks rather than 30 days plus one, or whether we open it up for other reasons. So I think that's a concern that I have. But I think there's a lot of questions still. But good start for discussion.
Carlin, did you want to make a comment?
I was just going to say quickly, we weren't able to cover this in the presentation, but it is in the report of updates to public noticing around giving notice to neighbors if the property has submitted for the STR lottery and been approved of a license. So that neighbor can be notified about it.
Well, being notified that you're going to have this impact in your neighborhood is one thing. Knowing that you're living with what you've already been living with is another. So now you're changing the rules. We went through massive public comment throughout the county on this issue. And most of it was people said, you know, I know I might have to live with what I've been living with, but I don't want it expanded. And if we're looking at doing that, I think we're going to hear from the public. I think a lot of these other recommendations are good, but as far as increasing the number of short-term rental licenses, I'm not sure. Just so we can create more revenue, I'm not sure that's fair to the
I want to clarify that
neighborhoods.
there's no increase in the number of STR licenses in the county. It's actually, what's represented in the report is below the
But if
number
we
of
start doing
licenses that
caps in
we-
different neighborhoods rather than historic use has a cap right there across the board. So are we going to take that historic number and split it up in different neighborhoods?
So essentially, yes. But what's been done in the report is to look at right now the share of total residential parcels within each master plan area that are short-term rentals, and then apply that going forward. So for example, if your MPA currently has 10, the recommendation for nearly all of them, I'm trying to picture the
Only
table in
be
my head as
10?
we talk, will be 10, exactly. So it's meant to basically allow for what currently exists, with the difference being that if a property, you know, if the owner moves away or decides to stop renting it, then someone else can step in and through a lottery take over that license.
But move it to their property, not in a property that already had an existing license.
Yes,
Right.
their
I mean,
property
it doesn't-
within the
Within
same
that-
plan
within
area.
that area.
Yes,
Yeah,
correct,
yeah.
yes.
Because it shouldn't transfer with title.
No, we know that, we
Right,
know that. No, I'm just saying is that I live next door to a short-term rental, or I don't, and then one comes available in my area, and all of a sudden I have a short-term rental next door to me. That's gonna be the hard pill for people to swallow.
Agreed. I think the goal is really, will the county be well-served in 10 years or in 20 years with a hard 2017 to 2021, is it? 22 rental requirement. And as the county evolves, that historical requirement is just not going to allow for much of a dynamic program. And it is effective, and your point that you're making, I think, that is that we need a lid on the total number, and it totally agree. And that is an effective tool that has been working in the recent past. Will it work that well over time? And how do we accommodate a changing market, knowing that the overall number should stay essentially the same?
So I thought we had a thing if we had, maybe that's another question. If we have X amount of short-term rentals and I'm gonna stop using my short-term rental license, could then my license go up for lottery throughout the county or within a specific area?
Just in your area.
But that could be a broader question. Should we open it up throughout the county rather than just in Woody Creek?
Yeah, I think that.
So we
That's a
keep the
fair
same
question.
number, we just put them in different places. Again, it's, are the neighbors gonna accept living next door to something they didn't usually live next door to? That's what we're gonna hear politically.
And I just also want to point out that, like, all of these recommendations really work as a system. So all the issues that maybe a neighbor is a little uncertain about that new use happening next door, I feel like we've really plugged those holes with these other regulations in terms of application requirements and enforcement and ongoing monitoring to ensure that community character is intact, whether the STR is
Yeah, and I don't
next to you or
disagree
not.
with that. I'm just gonna speak for the people who are not going to agree with that. Yeah.
Commissioner Mann.
Thank you. I was taking notes. I had some questions. I quickly made it through here. I think the first 6 were pretty easy. We could probably all agree on those. And then I got to the lottery, and so I think this is an important one. 2017 to 22 rule. I mean, I wasn't sitting here, but I was reading the conversations, and we all saw the need to do something. At a certain point, we're going to have to do something about that, because you can picture in 10 years or 15 years, it's just not going to make sense that we're holding permits only for people who were renting in that 5-year window so long ago. So I do think we need to come up with something. But I'm curious how the lottery would work. If it's like, if you win it, you have it forever until, like a liquor license, and then the house sells, and then that one goes away, and someone else can get that one. Or is this in use elsewhere, where you can cite an example? Is it a 5-year term? How does it actually work once you are awarded?
Well, once you are awarded, the idea was as long as you adhere compliance to all the standards and renew your license every year in terms of filling out the paperwork, you would be able to operate that in perpetuity.
Okay.
So you're not subject to another lottery over, 5-10 years later.
Okay.
Unless it sells.
Yeah, right. If it sells.
And it's
Sells, it doesn't go.
extinguished, but
Right.
then it goes back out for a lottery again. So you
Exactly.
have a finite number that will potentially never grow, or I suppose we could address that. So you're not taking it away from someone who had it for a few years.
Correct.
Okay. Well,
And Andrew, maybe can you speak if you've seen this in action in other communities?
So most communities have very few limits. Most see this as just another part of their community and how it operates, or they have a limit that is just handled. They don't necessarily have much specificity for how to handle For example, Silverthorne has one of the more progressive and well thought out programs in the state. And they have a limit by area that goes up to, I think it's 10% in the community-oriented neighborhoods, and then 50% in the more resort-oriented neighborhoods. And they're not reaching their limits yet. But it expands as the number of dwelling units expands. So there's this ability to kind of, a little bit of flexibility built into the system. But there, it's probably a wait list where, you know, as a unit becomes available, which is something that could be considered. We think wait lists are cumbersome and get out of date very quickly. And so we're not, I mean, we've seen wait lists, for example, in the affordable housing world, and you can have huge wait lists that are actually not.
Childcare.
Yeah, right. And so it's a more creative and more nuanced solution for tailored to the Pitkin market.
And the thinking being that with a wait list, a potential investor could buy a property, and if you're just willing to wait long enough, you know, you will get rewarded with that license, versus the lottery takes away that incentive to just buy a property to get, you know, perhaps someday the chance of getting your license.
Yeah, I think that makes a lot of sense. Yeah, okay. I mean, I could almost put another check on the column here. Jeffrey, well, think things over, but I don't know if you have any questions.
Question for Kara, which is, how come we've never pursued a lodging tax as a county?
I'll give my best guess. There's others.
She smiles in the room, so it's not.
I don't want one.
I mean, in all honesty, your land use code has been pretty prohibitive, so we don't have a lot of lodging until it opened up and that counties, one, had the ability. It was expanded legislatively beyond just marketing tourism, and to include STRs. There wasn't really an incentive.
Yeah.
Our incentive was through the land use code that any lodging was really focused within the UGBs. So I think a discussion about, do you want to look at one? Is it, you know, how do you want to explore that? What does it really gain? And that, as you consider the future of STRs, is something for the board to continue to discuss.
And we should say there are only 3 counties, according to our data, that are 3 hotels rather, that are in the unincorporated county. So
We discussed it years ago, and it was just hurting those small lodges in Pitkin County. And then when the state broadened it, so we did discuss it, but it was another enforcement of a tax, be it a lodging tax that could be used for good purposes.
If I can mention, and it might be good to go back to that slide, when guests come to Pitkin County, whether they're in Snowmass or Aspen, there is an expectation that they are paying taxes, and the guests, it's a pass through to the guest, and is the Pitkin Aspen Snowmass market elastic enough to accommodate this from a guest perspective? You know, that's a big question. But we do have, you know, the maximum would be 6%. And if you add that to the 6.9 that's on the books today, all inclusive of all the other taxes, it brings you to just below 13. And where's Snowmass Village? Snowmass Village is at 12.7. So this would be, I think, 12.9 compared to 12.7. So we do have an existing benchmark in Snowmass that would be essentially at the same level. And then we've got Aspen at 22.3, dramatically higher. So would you find resistance in the market? We haven't studied it.
One of the concerns we hear is for people who say it's too expensive to stay here. So they stay in Basalt, or they stay, you know, in Carbondale with the new hotels that are going on in Glenwood, and they drive back and forth or whatever. But we do hear that. Plus, you know, our roommates are already through the roof here, and that's why our people are staying less amount of time here and spending less amount of dollars here because of the cost of having to spend the night. That's in the city of Aspen, again, not really in Pitkin County because of those 3 lodges that we have.
Can you go up two slides?
Nice.
To STR
go back,
markets.
yeah. Yes.
So we were surprised, I'll be honest, when we did this research on the county, just to find out what STR hosts were putting their units on the market for. So at any rate, the question is, would these guests, how do these guests respond to that?
Mm-hmm. When you're paying $60,000 a night, I don't think you care. But when you're trying to pay $600 a night, you're going to care. And I myself personally would rather attract those $600 a night visitors to our community.
And that was also, so again, we sound like a broken record, but in the report, another option for generating funding for workforce housing for the workers generated by the STRs is a regulatory fee with a nexus study. And we recommended away from that because the size of the regulatory fee is based on bedrooms, which means a 2-bedroom unit for $1,000, or it's called 2-bedroom unit, $2,000 a night, would be the exact same as a 2-bedroom unit at $10,000 a night. And so a tax can scale with this, exponential curve that we see here in a way that a fee can't.
And if there was any market to have a scalable revenue source, it's Pitkin County.
And I guess the most fundamental question for me, Jeffrey, and then I'll because I know you guys have more questions, is do we care if the STR market goes away?
Right. I mean, it was addressing a serious community concern when this was all conceived. And
As far as a revenue generator, I don't have a problem continuing.
it doesn't have to be 6 either.
Yeah.
If we're
For the
concerned about
people
the
who
low
live,
guy.
who've been here a while, who rented their homes to pay their mortgages over the holiday,
Yeah.
that used to be what people did here. They went away for the holidays, rented their house, paid for their mortgage or their property taxes for the year. And those are the people, when we had this discussion from the get-go, we did not want to harm. And so when those people move away and they lose their STR license because they've moved and sold, do we care if we lottery those licenses out to keep that same number or expand the program? That's a broader baseline question.
And we should also say the type 2 license that's targeted at that homeowner is
Yeah.
not capped. So,
Yeah, but still.
yep, yeah.
I can't believe Breckenridge has almost 4,200.
Yeah, that's
The
crazy.
entire
They don't even have that many lodges in Breckenridge. I mean, no wonder they have a housing problem.
Try to flip the conversation for a second, which is if we have 40% of our homes are unoccupied, and we clearly have a need from the music school, from physics, from even skiing, God forbid we had a winter, could this be a tool to change that? So it's instead of thinking of going back to, is this a negative thing, but we have this asset, it's being underutilized, there is an opportunity, for example, to pay for your property taxes through rental income. But in exchange, we can house physicists, we can house music students, we can house, folks that are here for ideas. So, is there, and so I'm okay with the checklist seems okay, and the question then, does it become too, sort of second part is observation number 1, observation 2 is does this become too onerous, right? If all of a sudden I'm doing wildfire management in order to rent out my house, and does that become too onerous and we lose applicants through this process? So I guess 2 parts.
Certainly. And Nicole, I might ask you to think
the
about
students.
students and the wildfire. I'll just mention briefly that one of the participants in our focus group specifically was interested in accommodating music students and sought out the event and came to express their opinion, he and his wife, to want greater flexibility to actually accommodate that and be able to participate in housing music students. So I think that is real. I mean, we certainly heard it in the focus group, and there are people who want to be able to do that. In terms of wildfire, do you want to talk about that, or do you want to talk also about?
And number 1, probably number 1's more important, right? Which is because that would improve the community character, right? It changes the conversation from we have 77, we've stymied this thing, to we're really interested, how do we create this community character? And we have an empty, and I can't say East and West Egg anymore, but in unincorporated Pitkin County, do we have a way to drive the growth, drive the occupancy that we want to see, which supports that summer economy or supports that winter economy? And so we've changed the mindset from we're done at 77, call it a day.
So you're saying you'd say you can only get an STR if you rent to music students. That's what you'd have to do, or if you rent to this category.
There's a statement in the report that there is an option for the board to entertain an exemption for STR rentals that are housing exactly what you're saying.
5
communities-
employers.
Well,
picking up.
whatever
Yeah.
local events or
Yeah.
employers that you think are important, we can carve out an exemption for those that are really specific.
They wouldn't have to have a license, but would their, would their non-license still count in the cap? So you might have a neighborhood then that said,
It wouldn't count towards the cap.
so I live in a neighborhood that in the summer decided to rent, I live in a neighborhood of 40 units. And in the summer, they decided to rent 29 or 39 of those units to music students. Is that acceptable to the other neighbors? I would think I'd rather have that than have them empty or have them, but
Yeah.
I'm thinking of the neighbors.
Yeah.
Yeah, the cap is only for the type 1 and the redstone.
Yeah.
And in terms of onerousness, we just want to draw attention also to the update and permit fee, where currently the 3 existing license types, it's based on a percentage of the home's market value, which with the value of a home in Pitkin County, right, that's a very large number. This current structure that we've proposed is looking at $400 with a $200 per bedroom fee for the STR1 and redstone types, and only $200 for the low intensity licenses. So yes, there are new requirements being added in terms of kind of to-dos for water and wastewater and fire, but a large monetary burden has been taken off at the same time.
I don't necessarily have a problem with changing it to that system, but I think they do need to show water issues, wastewater issues, which I thought we already did wastewater.
The current program is really built on applicant representations.
Yeah.
And not.
This is proof of.
Right.
And I think wildfire would not be onerous, because we're trying to do that anyway. It'd be great if we could get them into the wildfire mitigation, program, and that would help reduce their costs.
Recycling? No. All right, earlier conversation.
Nice try.
Yeah.
That's only a redstone.
No, I agree. I think this is good. I mean, I feel like we're here to try to identify how to solve for the problem of 2017 to 22 rule, right? So I feel like this is a step in the right direction. I don't know what we need to decide today.
May I?
Please.
I was gonna jump in because I think it's good to maybe frame, and the work that you all have done has been incredible here, is like, what is the problem that we're trying to solve for with the current program? And I can try and summarize it, and then you all please jump in. But I think there's a couple different pieces, right? Which is the fee itself and the way it's applied. We know that that's been problematic and want to get to a different fairness factor in the way that the fee is applied. Is one piece of it. The other part is that we do know, I think Patty, you had the same question I wanted to pose to the board, is you all implemented these STR regulations as a way to try and manage and mitigate the impacts of STRs. And I think what you all have found and heard over time is that on the one end, you've got pretty big extremes that might have impacts that you want to try and manage and mitigate. And on the other hand, there's a benefit to local homeowners that you want to try and provide. So I think the question of, does it matter if we don't have an STR program, I think becomes a conversation about there's pros and, you're trying to balance two different needs within this STR program. So I think if you frame it that way, then you can go through the list of what's not working within the current program. And I might suggest if you all have clarity or want to give direction, or maybe cleaning up like what the goals would be of STR program 2.0 based on your discussion, that what we would be achieving, what would that lottery program be achieving as far as a way of filling the unoccupied beds. I think that's a really valuable point, and filling them and managing them based on proof, doing some improvements over the program, and a fee structure that is likely more fair across the board. And then I think the lodging question, I would suggest it's something to put on the table, the lodging tax, but it's not something that you have to solve for right now. I think just getting a new, whatever changes to the program to address what's not working today is your first step in moving forward. I don't know if that was helpful.
Yeah, well said.
Yeah,
Thank you,
that's
Carol.
helpful. Great summary.
It's interesting to talk about 73 short-term rentals when there's 2,300 in the city of Aspen and Snowmass, and maybe you're right. Maybe we don't need to keep that number fixed at that, but people do like short-term rentals as an option to hotels. But we're not the only. We're actually, when you look at one of those first charts, we're a pretty small player in the whole game here. So. I do think it's worked well, and the more I hear about the lottery, the more interested I am in that. It gives some people the opportunity. We've kept everyone happy who really insisted that they needed the right to do this for their own livelihood, and I think there's a lot of great things in the discussion.
We had talked in original initial discussions, how many years ago was that now, about capping per area. Okay. And we didn't have enough information at the time, so maybe that's something we can further pursue. The 31 days, the 30 plus 1 day theory, I don't know, for somebody who, having people, even people have worked it out by renting it to them for a lower price, and they only knew they were going to be there for 2 weeks. And those are usually the bigger units, bigger options, opportunities. Again, it's just the expectations of the neighbors having to live with the impacts, be they positive and or negative. There's kind of a mix, so.
So I guess if I had to if I broke your top 11 list down, I would say health, safety, and welfare is our purview. I'm on board with the guardrails, if you will, because I think that's the concern when you're not in rural, but you're outside of sort of where necessary services are, that we actually have a check. Community character is an easy one to sign off on. And I think the third one that we sort of added at the board table was, is there sort of event / employer needs that are going unmet in the community, given the unoccupied beds? And so I don't know if that's on the policy list to correct, but it goes back to the cap conversation. But there's something missing in a community where 40% of the beds are unused. If you turn around and say, wait, the music festival, physics, and ideas are critical, summer events, and obviously uphill and downhill are critical winter events. How do we align our housing stock with that unmet need? And potentially you're no longer commuting 90 minutes to enjoy those, 4 events. And so that third one I don't see in this policy discussion.
That's a bigger discussion, because then it would be, so if you rent to music students, that's for the summer or the music student session. If you rent for an event, that could be a week if it's a special event. So how do we break that down so we don't have, the creation of new impacts to neighbors that aren't familiar with that? Or do we blend that into the lottery system? Or so, I think it's a discussion worth having, but I think it's a broader discussion as to how we break it down.
Yeah, I think the short events are STRs, and I think you're talking seasonal, a different program for a full just before till just after the season, whether that's summer or winter.
Well, a lot of those are 30 plus 1 days. They can do it anyway.
They could do it anyway. Okay. I think it's very much worth exploring, though.
And they can do it anywhere, any.
And they're not. And if they're not doing it now, we're not going to be
the state lets
incentivizing them to do it.
State lets them do it.
Yeah, I mean, it might be a different conversation than STR because of that 30-day rule.
I think that what we heard was that there is interest in the community for incorporating this in for students. And I think they're looking for flexibility. And I don't know exactly how it fits relative to 30 days.
Broader discussion.
But it does, I mean, from our perspective, what are the larger goals of the county and what's unique about Pitkin County that we want to amplify in a good way? And the music school is one of them that just really stands out. And how do we align the resources, like housing stock that's not as occupied as it could be, with the goals that with the events that make Pitkin County unique? So I think that's a really helpful way to think about how to use this tool to fulfill larger goals. And I think as a team, we can give a little bit more thought to that. It's helpful feedback.
You need to talk with the organizations to see how long do they rent the MAA housing now with it, at either on Harmony Road, down by across from the airport, or the one at Merle Housing.
Right.
Those were created to fill those beds with music students. And I think they're like June to August. So
We can do that.
that's the time frame we're probably looking at, and people can already rent their home in the West End. They used to do it,
Right.
or they used to use their caretaker dwelling unit for music students, and we've lost that opportunity.
What we're hearing is
Andrew
that,
and then Kara, and then we're wrapping up.
Sorry.
Final comments. No, you're good.
You sure?
Yeah, you go.
What we're hearing is general appreciation for the suggestions with this larger, and Patty, or Commissioner Clapper, I want to
You
mention.
can call
that-
me Patty.
Okay.
Everybody else does.
Okay. I mean, you certainly expressed concern about the total number and the changing dynamics of where the impacts might occur. So we hear that. In general, we're hearing positive response to these with the suggestion that we also expand it to specifically include some of the larger programs in the county.
I knew you were going to summarize it well, and I'll add on to it. I think building off what I'm hearing as maybe next steps is there's general support, but I think curiosity about what a program would play out with. Hearing some of the goals that you all stated today, which is priority is health, safety, welfare. I think looking at, how basically a maintain, not a grow, not a reduce per se, but kind of a maintain with the stabilization for current homeowners. Look at what would exemptions or something that would be incentivizing for those local events. And it seems like a suggestion would be coming back with kind of what does that actual revised program look like, and the lottery for further discussion before coming back for code amendments, and having that discussion as you actually see that lottery play out with those goals.
And the area capping number.
And the area capping, correct.
Yeah.
Final thoughts, Andrew or Carlin?
This has been very helpful.
Yeah,
We
thank you.
appreciate all the feedback.
Thanks for your time today.
So you guys, are you staying and presenting to us between now and
We'd
then?
like
You're done
to.
looking at us.
We enjoyed your company.
Thank you.
Likewise.
Thank you
Thank
so
you,
much.
Nicole. Thank you.
Okay, thank you.
So we're gonna fly Brian, Diane, Mr. Christie, and Ryan.
There's other familiar faces here.
And if you leave cell phones or anything else, we will.
Yeah, etc. I've got your phone. Hello.
A bit of a low rider.
What?
Can I talk to you afterwards? I wanted to touch base really quick. Abby, do you care? Would you be able to
below the
promote?
table.
Oh, thanks.
Mr. Christie, if you want to slide around
me
because
with
you
the
want a
PowerPoint,
wheelchair,
which
you're
is
welcome
frightening.
to.
You mean about my 5-hour delay with American Airlines?
Mr. Fielding,
didn't have
welcome.
a
Good
flight
to see
crew.
you.
What?
That looks better.
There's another familiar face.
The floor is yours, Mr. Mahoney.
We're getting ready to put the slideshow up there, so we
Can
have a
I-
few slides to
While we're
present.
waiting, I have more jars of dirt
Oh, is that right? Okay.
available and ready to go.
You wanna
If
join us?
know of
I
peop-
provided one to our local ADO.
If you have any others you would like to give them to.
Intimidating,
Okay.
sitting at the table.
Got 'em.
You're going to bring some to DC, of course.
Where?
Washington.
Oh, yes.
Yes, yes.
I'll save some.
Yeah.
TSA wouldn't know what to do without me bringing dirt through the airport.
They're like, "You got these
And
scissors?"
blueberries on my way home from Virginia.
Mr.
Okay,
Fielding.
I think we're
Mr.
ready.
Mahoney.
Well, I'm going to take a shot at leading the presentation today. You'll be hearing from me for the majority of the time with some support from my friends here at the table and online. But this is our second time in front of you with these this new update format. So you can go to that next slide. Just as a reminder, we're kind of going through talking about communications and our approach there, what we're doing with airfield design and construction and those updates, as well as for the terminal, and then finance updates. Some of this that you'll see today is a bit repetitive, just reminders from the last time. And so I won't necessarily go through every line today. But as far as communications go, just a quick reminder of some of our regular communication outlets. So we have our 2 newsletters from the airport that go out. That frequent flyer is a little more project focused. And so that goes out a little more frequently as well than our newsletter does. And we do have our website that's getting updated now that we have Kelsey on board. And so I think that's going to continue to be our sort of most reliable source of information for project updates moving forward. And then, of course, we did initiate our biweekly updates on the 4th of August, and those are subsequently then getting turned into emails that go out to the AAB and to the task forces, just to keep them apprised of what you all are hearing. And then looking ahead at meetings we have coming up, of course, we have the updates, and I think one of the important meetings that we have coming up is a joint work session with you all and the AAB. And that'll be covering the design updates in this alignment phase. We do have our AAB meeting this week on Thursday, so we'll go over those initial program updates with the AAB at that time. And then we will be coming back to the AAB on the 17th of September. And that by that time we should have those final plans that include sort of the ultimate build out or master plan of the terminal land side, as well as phasing approach. And then we will also be having task force and a community open house to keep those folks apprised, and we're looking at a fall time frame for that. We haven't nailed it down exactly there, but that is definitely something on the horizon, just to keep those task forces engaged. So now moving on to the airfield design update. A lot of this probably looks familiar in this first set of bullets. We are underway with the enabling work. That continues, so that's exciting there. One of the changes, this final bullet here, is getting water service agreement and approvals through Buttermilk Metro and the City of Aspen. So it looks like we may, for an interim period, stay on Buttermilk Metro, ultimately looking to switch over to City of Aspen's water system once the project is complete and we get through sort of negotiations with them on that. As it relates to the runway plans for 2027, we have our 60% plans. You heard this at the last meeting, but we are expecting the 90% plans coming up in October. So that's essentially plans that are ready for permit submittal. So that's pretty exciting, and hoping to have that guaranteed max price by the end of the year. So that runway program really is moving forward quickly. And as it relates to the FAA, of note in this section, we do continue to have weekly meetings with them. Diane really taking the lead on all of those. And last week we did our second reading on being able to accept the grants for the approximately $2 million for that design, and then up to $50 million, but likely, with a $30 million guarantee that'll go into construction for next year. And if they're able to find additional money in the region, because of how we wrote that resolution, we would be able to jump on that quickly and accept that money. Airfield construction update. It was interesting to see this photo here, so that you can see the enabling work coming right along. We have this haul road that's been constructed, and that really goes from the Owl Creek side into the hay fields there, and we'll be still working on getting permitting for our temporary haul road that comes off of Highway 82 on the north end of the runway. That we don't have those permits just yet, so those are forthcoming. But they have finished this office trailer yard where their temporary offices will be set up for those contractors throughout the construction phase. We also have, we're getting ready by stockpiling. So we have piping coming in, being delivered. So that's here and ready when we're able to move forward with that, as well as the materials. So that material stockpiling, I would say, is probably one of the most important things we can do, because the quantity of it is quite a bit, and we want to make sure that we're staying ahead of what gravel pit production can do here locally and those kind of things, so that come 2027 we are ready to go and not falling behind on timeline for any reason. And then as far as the enabling work, the Owl Creek road and trail construction continues forward as planned. I would say nothing significant of note in this first section, but as we look ahead for the next 3 weeks or so, a water line that goes from the AOC to the south, that'll ultimately end up hooking in with the Aspen water system. That will start to be constructed. The Owl Creek Road relocation, moving that ahead. And then the trail work will actually begin as well. So we'll make sure that we're able to keep that open. We'll have flaggers out there and that kind of thing as needed. And then, as I mentioned, that CDOT access, we'll be looking forward to getting permits on that, and then continuing with the stockpiling there. So, terminal design. So the terminal design, so we have been in this alignment phase for a number of weeks. We have about 10 days or so left in that phase. The idea is at the end of that 8 weeks, we have a master plan as well as a phasing plan moving forward, sort of what we are talking about as a phase one or an opening day design that would meet our target construction budget of $191 million. One key element to this is that as the design team is moving through this alignment phase for phase one, as well as the subsequent phases, they're keeping in mind those common ground recommendations as well as those resolution findings, both from the AAB and from the BoCC meetings when you all pass those resolutions for the schematic design. So we should see that reflected in there when we get that final design. And once we finish that process, we would move into the design development phase, followed by construction documents. You can see that the times associated with these, it does say 16 weeks for the design development and then 20 weeks for that construction documentation phase. And then we would ultimately be ready for pulling building permits and being ready for that 2027 building season. And then as far as terminal construction update, obviously we haven't begun construction, but we are getting our ducks in a row to be ready for that. We do have the CMAR selected. We plan to bring them here to introduce them to you. You do see a familiar name on there, Kiewit, but it's an entirely different division of their company. So it's sort of their vertical division. And then we have FCI, who
we know well.
will be, yes, they are present in the valley and have done a lot of projects. And they may have even worked on this.
They did this building and the courthouse.
Okay. So a familiar name there. We are still working on finalizing contracting with them, but the CMAR has been involved with the design team as they're working through this alignment phase, which I think, from what I'm seeing, that's relationship is working well. So, and then the last thing here is just these technical working groups. As they go through this alignment phase, they have completed their work. So a lot of that information and sort of back and forth with these groups is, kind of resulting in what we'll see in the final design for the alignment phase coming up here soon. And then lastly, here's just a quick update on finance and that process. A lot of this is probably familiar to you from the last, but we do have the CMAR for both the runway and the terminal working with the design teams. We know that those the costs, as we're getting further in design on the runway, we're seeing those costs go up some. So paying close attention to that, working with the CMAR on, understanding the why behind that and what, if anything, can be done there. And then, I think as it relates to the terminal, we're still very much in the beginning phases of working with the CMAR and kind of following suit with what we're doing on the runway. The cost estimates, every time we get new cost estimates where the CMAR as well as our independent cost estimators, those are getting turned over to our finance team to help us with the cash flow forecasts to understand where we are with not only the current cash on hand so we can pay those costs, but then also forecasting into ultimately when we might need to issue debt to be able to cover costs for the runway initially and then terminal. And then we continue to work on our financing strategy with our team. And the good news, we did, as part of that, get our rating from Kroll. That's just an initial credit rating, and that came back as favorable. So that's looking good for the airport. That will be followed up ultimately with a formal credit rating before we go to issuance. And then I believe all of you are aware that we did have our underwriter already in place and ready to move forward. That's Raymond James. And we actually have sort of a team. It's Raymond James, Bank of America, and I believe it was Wells Fargo working together as that underwriting syndicate. And lastly, this is a slide that you have all seen. Is it not on there?
It's not.
Oh, it's not on there? Okay.
Yeah.
Oh.
It's one that you've seen. But
Oh, we've never seen that one.
I'll show it to you. Sorry, it's not on there. But that generally is the update for you this week, and more to come, but happy to answer any questions.
Patty, Ted, and then Kara.
Yeah, real quick, can you see that Francie and Greg get this slide deck since there was some packet information in our,
Yep.
because I think they want to keep up to speed.
Okay.
The other one is about the build grant, and I'm not sure if that's going through Public Works.
I believe Gabriel and Linda are both working with Tracy at Department of Transportation
Okay.
on getting that through.
Because if we could get that finalized, and I don't know how this fits in with the terminal design, but I think it's another piece to that puzzle. So if we can get that $2 million for planning ASAP, then we can bring it in, because I don't want us to plan a terminal and then go, whoops, we planned a multimodal over here and we really need to have it over here. So let me know what we can do to help. Should I?
Let's chat.
Yeah, to make sure we get that money in our bank and can start. I don't know who's actually gonna be planning the multimodal. who's going to be working on it? Is it part of the terminal design team,
So
or?
the terminal design team had in their scope some, I guess, high-level scoping for multimodal, and we definitely went through a number of iterations of how to accommodate multimodal. Some of it without great specificity because we don't know what
Right.
all of those future multimodal options might be, but we aim to future-proof the design so that we can accommodate what may come.
So this planning grant money will maybe help facilitate that.
Yeah, and probably
Be
a little
nice to
less on the specific design for that we're doing on the terminal air side, and it may dig in some more on what elements
I'm
might
talking
need to be built,
location
but it's
and accommodation of the terminal coming out. I mean, that piece of that puzzle needs to be planned.
and a lot of that has been planned, so that's fortunate. So we're kind of we're in the game as far as
This
that
grant
goes.
money should help to fine tune that a little bit more.
Yeah, and it even takes, I believe, from when I read it, it takes on the scope of going from Brush Creek to the entrance, more or less. So it'll pan up
It
a
could
little
incorporate it more.
Yeah.
Okay, thanks. Thanks.
Ted.
Thank you. I like the updates. How much, regarding enabling work, how much or is any being done under lights after hours? It seems like driving by, there's some activity, but I didn't know if people were asking what's going on in the schedule for that.
What I understand so far, some of the stockpiling was perhaps occurring under lights, and GR might have a little more intimate knowledge if there's something other than that has happened.
The stockpiling is one of the primary activities at night. They've been cutting in a new vehicle service road on the southwest end, and then there is some of the stockpiling is material coming off of the Owl Creek Road corridor to the stockpile near the AOC. So those are really the only three things that are happening, and they're alternating through the different nights.
And you may see red flashing lights on barricades just to mark those stockpiles because of obstructions for aircraft. So I thought that was a very good point, that you may see, a random light on top of these piles, correct?
Oh, new lights, okay. Yeah, it's good to know, just, I think for community's sake, or people are asking, like, what is going on? Or
And you can see the construction trailers coming by 82, so they
Yeah.
can definitely see some changes happening at the airport.
Yeah, all good. Just was curious. Thank you.
Can I add one more thing really
Please.
quick? I know this is a minor detail, food catering for construction workers. Who should I put people in contact with? Because I hang out a lot at some of the local restaurants.
Oh, yeah.
And I've found some interested people wanting to see what they could do to help catering.
And I think,
Should I?
do we have a contact from Kiewit that
Oh,
we
yeah,
might?
absolutely. I
Okay.
think if you provide that contact,
I'll get it to you
any
guys.
of us or
Perfect.
GR will make sure
Perfect.
it gets to the
Yeah, because
the
they're excited to
project
help out.
manager there.
I think they have some great ideas.
Ryan, can you share with the board the air quality update that you're sharing to the AAB with the board itself? Because I'm assuming on September 1st we won't go through the air quality, but it'd be nice to see that update from Eden Hunt.
Sure, you want to take
I was
that
going
one?
to say I might be able to speak to this
Or
too,
that.
Jeffrey. We actually have a video. Roger is coming in with a video for the AAB for that analysis, but there has nothing on there that has alerted us to high levels of things. There are a couple of spikes that were related to some of the wildfires and things like that. So they've really been doing a good job at trying to tie that raw data and spikes that they see back, because one spike in particular happened when we were closed for the temporary construction. So we'll dig into that, and I'm happy to bring that kind of update back to the board once the AAB has had that as well.
Good question.
Thank you.
Don't forget Kara was waiting patiently when I interrupted her.
I want you all to have your discussion first. The only other item, and I think we'll start adding these in, is I know that you all have gotten requests related to busting and kind of talking about our continuity planning for the closure timeframe. So just so you all know, I think there's another follow-up email that came out this week about that. We are working with CDOT. Our CDOT representatives are a part of the group and are kind of taking the lead on that bus staying request, but we'll keep tracking it, and as we get more information, bring that back all to you all. And I do know that Eagle County is interested as well, so we're trying to coordinate at the staff level between Eagle County and CDOT. And as we get more information, we'll bring it into these updates or elsewhere.
Was that the request to stop at Eagle Airport?
Yeah. And there's an additional effort of a coordination between Pitkin, Eagle, RAFTA, and CORE, their transit, not our CORE, but Eagle County's CORE. So we're all trying to look and see what those transit options are.
Right. I'll throw it out there. It's going to feel a little random, but it's transit related, which is one of the unique solutions posed by the Up in the Sky Festival was they used the empty buses coming up here to do the local shuttle as a way to charge to get up here. So in other words, if you were attending the concert from Denver, it was $150 round trip from Denver to attend Up in the Sky. The buses would have come up here otherwise unoccupied because they were basically local shuttle buses between Snowmass, Buttermilk, Aspen, and Brush Creek. And so I just thought that's a fantastic solution.
I'm so happy you brought that up, Jeffrey, because I know that you had told us about that yesterday, and it's definitely something that we'd like to look into and see what service provided that to, whether they were involved in any kind of RFP process for us or what they could offer, because it is definitely a creative solution.
Yeah. And it was exceptional service. It was high-end coaches and just really well played, and various sizes as well. So it wasn't like you're just getting on, a RAFTA scale bus, if you will. So.
Nice.
And just while we have you, because we're about to do future agenda, anything further? Anything we missed? GR? On September 1st, it's a joint meeting. We currently have 2 hours, but we have a 45-minute break before it. Would you like more time? I mean, I think we'd all like more time in life, but would you like more time? Or we could take that at future agendas. Because currently we have you at 3, but we have 45 minutes.
We can see how things pan out in the next week or so, too.
It's a 45-minute break beforehand.
There was something we wanted to bring to the board, which is why, separate from the joint meeting, so let's talk.
Okay, there's room in the schedule is what I'm flagging.
Okay.
And I'd rather have a deep, informed conversation than say, oh, sorry, we're done at.
Okay.
Sounds great.
Mr. Christie, good to see you.
Thank you.
Thank you. Diane, good to see you.
Thank
you
you.
for doing the commute up here at 4 o'clock on a Tuesday afternoon.
Certainly.
And Brian, good to see you. And Ryan, good to see you.
Oh, thank you.
Thanks.
Likewise.
Thank you, Liz.
And Liz.
Thank you, Liz.
And Abby. We're going to switch to open discussion as we change over the room. Future agendas. So September 1 right now, we do have a 45-minute break. We have two, we're meeting as 3 boards that day. We have open space, we have AAB, and we have general board.
Let me
We
get
have
back
45
to you.
minutes
I feel like
before AAB.
There was something I feel like we were flagging as a potential agenda item on September 1st that is not coming to me. Let me.
For which meeting is this?
September 1st, we currently have a 45-minute
Oh,
break
yeah,
before a joint meeting, and then we get thrown out of the room at 5.
Well, yeah, but I think we probably can't make that decision right now because who knows what comes forward in the next week or two.
Okay.
I know there is
But
something
that's
at
a
the
good
staff
flag.
level that we were maybe looking at September
Squeezing it.
1st for that is not coming to me right now. So,
Okay.
but if not, then we can look at changing those times.
Anything else, future agendas?
I do.
Please.
On the 26th for our regular meeting, right now there's 13 items scheduled.
Oh, add
Can
one
we
too.
try not to add more? Because going 17 to 20 items on a regular meeting agenda is a little much. Not necessarily the meeting itself, but preparing for the meeting. Since we don't get the packets till sometimes over the weekend, it leaves a lot for us to do between that and the actual meeting date. And the other one was, this is another far out heads up, but on September the 9th, regular meeting, item number 10 has a typo.
Nice.
It's not ordinance, it's ordinance. Just because we want things to be properly noticed.
Great, thank you.
That's regarding their sign code, too. Well, I'm going to stick with Patty on that one. So on August 26th, I don't see the White River National Forest. Did we really move it to September 9th?
We
So
did.
the
We did it.
macroinvertebrate is not coming back 2 weeks later? It came
Yeah,
back?
it was because I think of staffing availability, so.
Okay, so it is-
Because the
it
Forest
yeah,
Service wasn't
so
available.
I think you all clarified in your motion that
Okay, it is.
September 9th.
I did.
not
Perfect,
September.
thank you.
Can I make a note real quick on
Please.
the 26th? It's not reflected in future agendas, and hopefully Sam is listening, we'll make this. I did chat with Dale and Gary, and just
Oh.
because of Snowmass Falls, we didn't want it to be in the middle, so
Right.
it works best for the Forest Service to move Snowmass Falls to number 6, so it's the first of your second readings, just so we could have most of the Forest
That's
Service
fine.
representation there.
Cool. Is number 6?
Yeah, so we will move that up.
Awesome. And the rest of it's airport. You don't need to move anything else?
On the 26th.
Faloha can stay on its own where it is, even though it's open space?
Mm-hmm.
Yeah, okay. Cool. Anything else future agenda?
I do, well, kind of a future agenda. On Thursday, you and I are the only ones carpooling, or is anybody coming with us?
I believe it's just you and I carpooling. I think I will double check, but Francie thought she was gonna come.
Francie's gonna try and meet us there. I didn't know if any other staff was going, because they said we might have 15 people.
I know the sheriff is going. He is likely gonna take his own car. I chatted with him, but
Okay.
there's only a lot of other stuff.
So will you let me know where you want me to meet you?
Mhm.
Because I can walk in and we can drive from here if you want. Okay.
We'll get connected there.
And was anything else added, or those the 2 agenda items for the 26th?
Those are
Or
the 2
20th?
agenda
Sorry,
items, yeah.
20th, thank you. Anything else future agendas? Going once?
The only other piece is I did want to confirm that I'm skipping too fast. The special meeting for the executive session on September 3rd, I need to confirm with Rye, but we were hoping to maybe have the actual meeting and be offsite over at the APD building.
APD building was full, I thought.
That's the Wakanda meeting?
Oh, sorry, Aspen Fire Protection
Yeah.
District at the
their
the
boardroom?
Recondo meeting would be over at the fire.
The APD
district
was
meeting.
full and the library would interfere with their time frame.
But I think, I will check with Ryan Sam, we would still need to come here first to go into executive session, and then would go over there and be offsite for the day.
Awesome.
For the meeting. That was pretty good.
It was that was not in future agendas, that was mailed out by Jeanette.
Yes.
Okay.
I guess the only other item that I think, Jeffrey, you might have flagged is I understand the Pitkin Democrat dinner is on next week, and so.
Next Thursday.
So I just need to know if, I'm assuming we should probably post that as a.
You should post it. I don't have a ticket, but sometimes I just show up and listen to the speakers and don't eat dinner.
Okay, so we'll make sure we get that posted for next week as well.
Awesome.
Hopefully this year they're not doing 2 hours of awards.
No windmills. Open discussion.
Were they windmills or lighthouses?
What?
I want you to clarify whether
Anything
they're
else in open
windmills or
discussion?
lighthouses.
I have one item.
Please.
So I know some of you have been talking with Alycin. I want to talk a little bit about Pitkin County Cares.
Oh, yeah.
So I'll start with the first of the selection committee. So I think Alyson's gotten to talk to a lot of you. What we are looking at doing is bringing in some past participants or past winners as well, and then wanting to see about if board members are interested in being on that selection committee. I know Patty's has voiced interest. I would recommend that we don't have so many that we have to post any of that process.
I just offered because I did it in the past. And I did it, also the sheriff participated with me in the past. So that's why I'm interested in doing it this time, if that's okay with the rest of the board.
That's okay. I have a lot on my plate. Yeah.
All the rest of my board members.
Yeah, yeah.
All 2 of you.
I'll check with Greg and Francie, but I think that'll be good. I know Allison's been doing a lot and connecting with all of you and Abby and the whole team about how to kind of revamp that selection committee, so I think that'll be great. The other piece is, so Patty, you can remind me here on some of the history. We used to do it right before regular meetings, Pitkin County Cares, but it was a lot for the board, or it was in the middle of budget season. We then moved it to do, I think, Tuesday mornings or Wednesday mornings, which would either be out here. Last year it was in the Dunaway room because we had so many awardees. We are keeping it tighter at that 7 award limit. So I think the question is, when would the board be interested in having Pitkin County Cares? We're looking at either Tuesday, October 6th, but I think we talked about so we could do it before or after the meeting, the work session meeting, or Wednesday the 14th, but it would be after your regular meeting, and I don't know if you guys want to do that.
Well, plus we never know when the regular meeting may be over.
Exactly. Or Tuesday before the BoCC meeting.
I would suggest that we do it on a Tuesday, because we don't start a regular meeting until 1, and do it in the morning, and do it with a light lunch like we used to, like bring it back to where we used to do it, how we used to do it. And where we do it, the Dunaway room, I think was great, but if we want to broadcast it, we can do it in here with lunch or whatever served out there.
Better than a Wednesday, yeah.
Yeah, Wednesday, yeah. Because we have to start at noon on Wednesday, and that doesn't really give us time to do the awards and meet and greet and have lunch.
How long does it usually take?
Last year took forever.
Okay.
I wasn't here. Okay. But it doesn't, when you have 7, some people like to speak, some people don't, because they're just a little shy. So it's about 2 hours total with lunch and stuff.
Yeah.
So we'd start at like 10-ish and then have time to have lunch and be a break before we start at 1. Does that make sense?
It adds up.
Yeah, and just let Rye know we won't have exec that day.
So I will check between Tuesday, October 6th or Tuesday the 20th. I think my recommendation is once we cross October 13th, you're in deep budget, and so it might be better to try and do it on the 6th if it works for.
And we haven't really determined exact dates for Washington, because I'm sure the week that we're thinking about going, that's when Congress just gets back into full swing.
We've got so that I'll go there. We have confirmed the dates are the 15th and 16th. And so that is when Congress is there.
I know, but I don't know if we'll be able to get any appointments. I'm not going back. We got appointments with all of our representatives and with FAA.
I double checked, but we've got appointments with Hurd's office.
So we'd fly in on the night of the 14th, because I would like to be home the evening of the 17th, at least to Glenwood Springs.
Yep.
So Clapper and Jacoba are out on the 15th?
Yes.
Perfect. And I'll bring dirt in my suitcase. TSA doesn't know what to do without a suitcase with dirt in it. They didn't open up my suitcase. I was shocked.
It says 3 ounces.
What is a Winter X?
Are you looking?
What are you looking at?
September 15th and trying to figure out what they're missing. Roaring Fork School District Partnership and then Winter X permit.
I'm guessing it should be Winter X Games permit.
Okay.
Probably.
So there's no reason to change that calendar date, given we have 2 absentees. That's all I'm looking at.
I think today would have been a better day to have a full board, because I think the discussion we had in exec was really beneficial, and the other ones we had here with the presentation of the STRs, I think is critical for 5 people to be on board.
It's not a calendar edition, but I sent you an email regarding Lieutenant Colonel Dick Merritt's service will be on September 26th. It will be at 11 a.m. and the hope is that it's in Veterans Park. Just looking for permission from Pitkin County to hold that service and have set up.
What day of the
areas
week
here.
is that?
Saturday. So it's as per Colonel Merritt's request, that it's not at the cemetery, that it's at Veterans Park.
And then there'll probably be something at the Elks following, I would imagine.
So September 26th, 11 a.m.
Yeah, I'll put that on my,
And then I do think we're looking at a proclamation.
That Wednesday, the 23rd.
That Wednesday before.
Yeah.
Is that on
So
there?
we'll do the proclamation here in the boardroom, and this way we leave the 26th as special with the honor guard and sort of full honors, if you will, on the 26th.
Do we have that listed? Wait a minute. Okay, we'll make
you
sure
said
that.
September 20?
September 26th and
It's National Public Lands Day.
11 a.m. at Veterans Park, outside our offices here.
Thanks for that.
Yeah, and we're coordinating with the Veteran Services Officer, Pamela, and with retired Chief Valentine.
Okay.
Anything further? Seeing none, we are adjourned. Happy Tuesday.
Thanks.
Enjoy
Thanks,
your
guys.
afternoon. Thank you, Kim. Thank you, Abby.